In this video, I'm going to teach you everything that you need to become a consistently profitable day trader from start to finish, even if you're a complete beginner with no experience whatsoever. It's the same thing that's made all these traders on screen now profitable, and if it's worked for them, it's going to work for you too. It is the absolute best of my teachings combined, and on screen now you'll see the key chapters, so feel free to skip around to whatever you think is relevant for you.
Okay, so what actually is trading, right? Trading is literally as simple as it. It's buying and selling for a profit. Right, let me say that again. Trading is literally buying and selling for a profit. That's all it is at its most basic form. And there's so much BS in this industry designed to essentially confuse you. All you need to think about is buying and selling for a profit, right? That's all we do as traders. And this is what we do in any market. Now, a market is just something you can trade. But right here is the S&P 500. Now, most of you probably know this, even if you're not traders. This is the top 500 companies in the US, right? And this exact thing you can trade on Tesla. So we just type in Tesla here. Right, we get Tesla up. Tesla, just a stock in the US. You can do the exact same thing on Tesla, on Bitcoin, right? On Bitcoin, any financial market. Now, a financial market is just something that essentially has these candlesticks. Anything that has candlesticks, the only reason that traders participate is to buy and sell for a profit, right? Traders are not investors. They don't buy, let's say, buy and then hold for like a year or two. That's not what traders do. That's investors, right? Traders are here. We're holding for. Most traders, most day traders, and we'll get on to day trading later on, most day traders are holding for a few minutes to a few hours. Most swing traders, like me, are holding for at most a week or two. So if you're a trader, we're buying and selling, very short-term movement. We're here just to buy and sell, make money, and get out of the market. We're not here to hold on for 20 years. We don't care about that. We're here just to make money quickly and to move on to the next asset. Okay, so now that you know trading is about buying and selling, the next thing we need to understand is what is a candlestick chart. Now, a candlestick chart is essentially this, right? Because any market that you trade, it's going to be shown with these candlesticks here, right? Like this. Now, if this was the first time that you've seen candlesticks, this probably looks like absolute gibberish to you, but I promise you, it's really not that hard. It's just, it takes maybe like a few days to get used to it. But what a candlestick chart actually is it's just a way of representing information, right? So let me just go back on this. You've probably seen, let's say if you're like an investor, like the S&P 500 on a line graph, right, just something like this, right, like a line graph. Yeah, okay, that looks good. But as a trader, there's virtually no information here, right? There's no information here. Now, as traders, we need information, especially because we're short-term traders. We need a lot of information so we can make decisions very quickly, right? This isn't like some line graph, because the line graph is very limited. So we need these candlestick charts because it tells us a lot of information. Now, what it actually tells us is there's two types of candlestick charts, so bullish and bearish. Now, bullish just means buy, or up close candle means up, means price has gone up, and bearish means short, right? Means price went down, means people sold, right? Green means up, red means down. So we go in here, this candle here is a green candle. That means it was bullish. That means that price went up, right? Price started off here, it went all the way up here, and it closed down here, right? That's what a bullish means. That's what long means. They mean the exact same thing, right? Bullish slash long, bearish slash short. They're the exact same thing. Now, this candlestick here is a short candle, right? That means that price started off here and then it stalled, it went down all the way down here, right? That's what bullish and bearish actually means. So for the candlestick chart, or the bullish example, this low of the body when it's bullish, right? This is the open. What this means is for every time interval, right? Just stay with me here because this might go over your head at first, but just really do pay attention here. What this means is for every time interval, this is where price opened. Now, by time interval, we can choose what time frame to trade. But right here, we're on the 1 minute chart, which means every single candlestick here represents 1 minute, right? So this is at 8:40 a.m. Right? This candle here, 8:41 a.m. This candlestick here, 8:42 a.m. and so on and so forth, right? Now you can change this time frame to the 5 minute, 15 minute, 4 hour chart, the daily chart, whatever. And then let's say it's a daily chart. Each candlestick will represent 1 day, right? 1 unit of time. That's all it means. But for that example, we're on the 1 minute chart. So what this means is that price will open, right? It will start off, price will start off on the time interval at some sort of price here, right? This is the low that price will do. So let's say price opened up here, it moves down here, it goes all the way up to this high, and then closes there within the minute, right? Within 1 minute, this is what price did. It opened at some level, it went down, it went all the way up here, and then it closed within a minute. And now close means where price was at the end of that minute, right? So at the end of the minute, where was price actually? And then the open is where was price at the start of the minute, right? So the start of the minute, it was here. At the end of the minute, it was here. And then the wicks here, which is just the bit that points out on both sides. That's the absolute highest price price was within the first minute, right? Within the minute of that candlestick, if you're on the 1 minute chart. And this was the absolute low that price went to if you're on the 1 minute chart, right? And the exact same thing here, right? When you're bearish, the only thing is when you're bearish or when you're short or when you're looking to sell, you just flip on your head, right? So for these candlesticks here, which are red, right, you flip it on its head. So let's say, because we're on the 1 minute chart, price opened, right? It opens here, it goes all the way up here, right? Within 1 minute or within 1 day or whatever the time frame is, price starts off here at that minute, it goes all the way up to this high, it drops all the way down here, all the way down to this low, and it moves up, it retraces slightly, and then it closes here, right? That's what a candlestick does. It shows us where price started off in that time interval, where it ended, and the highest point that price was, and the lowest point that price was during that time interval. Now, as traders, that's very important, and especially as we get further on into the course, that's quite important to understand, right? And if you compare that to a line graph, which has virtually no information, and candlesticks by far, night and day, are way more important for trading. But as always, with all things, it takes a few days just to get used to candlesticks. Okay, so just to recap, the green candles are always bullish, which means price is going up. The red candles are bearish, which means price is going down, right? And then for the bullish candle, what this candlestick represents is that price opens here, it went all the way down here, it went all the way up this high, and then it closed at this point here, right? For either some unit of time, whether that's the 1 minute chart, like it is here, or it can be 2 minute, 3 minute, 5 minute, and 5 minute here, the 1 hour chart, the daily chart, the weekly chart, whatever it is, this represents 1 unit of time, right? And time we can just mess around on this platform. And this platform is tradingview.com. Every single trader is using tradingview.com. Every trader uses it completely for free. And go get this up, go look at your favorite instruments, go type in Tesla or Bitcoin, or the S&P, which is ES. Type in anything that you want. And yeah, just go look at these candlesticks, go look at them, and make sure you understand them. Green means up, means that price has gone up, or bullish, as we call it as traders. And then red means that price has gone down, or short. Right, that's what we call it as traders.
So, for daily buyers, the first thing you want to do is get the weekly chart up. And that might sound, contradictory to the name or whatever, but the weekly chart is probably the most important chart. Not probably, is the most important chart in all of trading, because smart money, big banks, Goldman Sachs, whatever you want to call them, they're looking at the weekly chart and the daily chart, and then they're executing on the 4 hour chart. They're not looking at the 5 minute chart, not to do their analysis. And I'll show you in probably the next 2-3 minutes how much you can learn from just the weekly chart alone, right? So here we are on Euro USD, and here we are on the weekly chart. Now, the first thing I like to do when I'm studying daily buys and I'm studying these charts is I like to look for the overall trend, right? I want to look for the most recent trend in price action, right? So I don't care about this bit, I don't care about the choppiness here, right? Because remember, this is the weekly chart, so the emphasis is always on the most recent price action, right? I don't care what happened, in 2021, right? If this was like the 15 minute or 5 minute, I would, but this is the weekly chart, so I don't care about any of this, I don't care about any of this. I only care about the most recent pricing, and it's pretty obvious what price has done. Right, bullish, strong trend. Now, I'm going to show you right now, I'm going to compare this to a few different markets, and I'm going to show you how much we can learn from just this weekly chart, right? So this is euro dollar. Remember this chart, right? And remember this high, and this strong, aggressive move up, right? So here is GBP USD, right? Again, very similar. So let me just show you again. Very similar to euro USD, where we've got this huge move off, and then GBP USD, right? Where we've also got this huge move off, right? Very similar. These weekly charts here are very similar. Now you might be wondering, okay, Atif, where am I going with this? What does this really mean? Now watch this. This is really important here. Let me just clear this off. This is really important here. So here's euro dollar, here's GBP USD. Let's go look at Australian dollar, right? So remember this high and this high here. Look at this, right? Look at this. This is so important right here, because this alone tells you so much. So here's the high on Australian dollar. Let's just get New Zealand dollar up too. Here's the key high that price does not take out, right? Like this. So we've got NZDUSD, AUDUSD, and then GBP USD. Can you see how price takes out this high right here, right? Now you might hear this be called SMT divergence, or just divergence in general. The name does not matter, but this right here in price action is such a key clue on the weekly chart, right? This on the 5 minute or 1 hour chart does not matter, but on the weekly chart, this is smart money screaming at you. And what they're really saying here is, can you see how price took out this high on euro dollar. It does it on GBP USD. It does not do it on AUD USD, and it does not do it on NZD USD, right? What does this mean? Because everyone can spot divergence very easy, right, to pick. Hey, it didn't take out this high, but what does this really mean? This is so important, right? So make sure you write this down. This right here is worth its weight in gold, right? And I'll explain why it is later on. I'll show it in gold too, right? Just so you know. What this means is that euro dollar, euro USD is very strong. It's a very, very strong currency. Similarly, with GBP USD, it's also very, very strong, right? Whereas with AUD USD, it's a weak currency, right? It's a weak currency. Same thing with NZD USD, right? The fact that they couldn't take out this high is on the weekly chart, right? Not some random, 5-minute, 1-minute chart. On the weekly chart, it's smart money screaming at us that NZD USD is very weak. AUD USD is very weak too, whereas GBP and EU are both very bullish. Now, what does this mean? This means that you only look for longs in euro dollar and GBP USD, and you only look for shorts in AUD and NZD USD, right? Super important. Go rewind that, right? Make sure you only look for shorts in NZD and AUD, right? And only look for longs in GBP and euro, right? Now the reason is, and this is so important, and every trader, right? Everyone who's traded has had this, right? Where let's just imagine, let's just say you're bearish, right? There's some sort of bearish fair value gap. There could even be a liquidity sweep. So if you know what a liquidity sweep is, it's just a stop run. Some old high gets taken, price goes off. There's lots of fair value gaps. You enter into your trade, let's say at fair value gap, order block, Fibonacci, whatever you like. And then price just chops for ages, right? It just chops, it goes down a bit, and it comes up, and then, maybe it just touches your stop loss and then just chops for ages, right? And price just consolidates. It does nothing, it just chops around, and it's so annoying. And the reason why this happens is because you go short in a very strong currency, right? You go short in a very strong currency, and this is what you get, right? So you never, ever, ever go short on a strong currency. You never, ever, ever do that, because that's what you're going to get. You're going to get choppy trades, and you're going to lose trades, right? You're going to have so many unnecessary losers, and that alone can take your win rate from 40% to 60%, right? And that right there can make you a millionaire very fast, right? You can make money very, very fast with just this little tip alone, right? This right here saved me so much money. It's insane, right? So GBP and euro dollar, you only look for longs, right? You only look for longs. You do not short this, because if you do, if you short at some fair value gap, price will chop for ages, and it will go and take out your stop loss, right? The only currencies, and I'll show you more, analysis later on, but the only currencies you want to be shorting is AUD USD. Look how weak it is, right? It's very weak. As soon as you get into the trade, and you've all had trades like this too, right? Let's imagine there's a fair value gap. You like entering on it. As soon as you enter, price just drops, like, whoa, straight to take profit. And you're like, oh my God. And then, you actually, we've all had this too, right? So let's say you've got your stop here. Let's just imagine there's a fair value gap, random fair value gap here, right? And then you've got your 3 to 1 or whatever you aim for, and then price comes all the way down, and you think, oh man, should I aim for like a 10 to 1 or whatever, right? You see this, and the reason why is because you're shorting a weak currency, right? And if you short a weak currency, price will just drop like a brick. Similarly, imagine you buying euro dollar, right? Imagine you buying it through all of this move right here, right? Any retracement you get on euro dollar, let's say there's an order block or whatever, price will just shoot right off to take profit. And you see this over and over and over again, right? So this alone, and notice how I haven't even gone below the weekly chart. This alone tells me right away, euro dollar, GBP USD, I want to look for longs, AUD and NZD USD, I want to look for shorts. Now, if you understood that, congratulations, because that's very, very advanced. Hopefully I've not scared you off too much, but I'm going to give you almost a little test, right? So all of these currencies have USD at the end. What we're now going to do is look at dollar CAD, dollar Swissy, dollar Swissy, and then dollar yen, right? So what do we notice here? Study this low here. This is the low we care about, right? So let's just mark this down. This is really important right here, right? So here we have price does not take out this low on dollar against the Canadian dollar, right? And then dollar Swissy, right? Look at this. Now, what does this mean? Right, just think about it. Just think for a few seconds. What does this mean? If dollar Swissy took out this low and dollar CAD could not take out this low, right? What do I want to be doing in dollar and the Swiss franc? What do I want to look for, longs, or do I want to look for shorts? Right, hopefully it's pretty obvious that price is so weak, we only want to look for shorts in dollar against the Swiss franc, whereas dollar CAD, relatively is a lot stronger, so we only want to look for longs in dollar CAD. Right away, we can just filter out so many low probability setups, right? So we only look for shorts in dollar Swissy, only look for longs in dollar CAD, right? Now, dollar yen is pretty interesting. What do you see here? All right, think for a few seconds. What do you see in price action here? Right? I see choppiness. I see choppiness, right? And you know how I said, the first thing I always like to do is look at the most recent trend? Well, there's not really a trend here, right? This is a choppy market. And if price, and this is a really, this is a gem right here. I'm giving you a lot of jewelry, aren't I? Right, so we're on the weekly chart. If the weekly chart is consolidating, every other time frame will be consolidating, right? You probably hear ICT and other people talk about price being fractal. What that really means is if price is consolidating on the weekly chart, it will do the exact same thing on the 5-minute chart, right? Like, let's just imagine, forget this is the weekly chart. Let's just imagine this is a 5-minute chart, right? You enter on this fair value gap here. Let me just mark this out, right? Let's imagine you enter on this fair value gap like this. You put your stop typically at the high, and you target whatever, right? Liquidity or whatever, and price just chops around, right? The reason this is happening is because the overall market is consolidating, right? So what that really means is ideally you should avoid this, right? You should avoid it. Overall, it's more bearish than it is bullish, right? Because there's no respect of these order blocks. I know some people love this pair. Look, listen, if you want to go short, easy short. You want to go long, dollar CAD. And of course, you've got Euro and GBP, right? Now, let's do the exact same thing on the S&P, right? So here's the S&P. Here's NASDAQ. Here's Dow, right? The three golden indices, right? The three American indices. What do we notice right away, right? Price does not, on Dow, does not take this out. And this is the exact same thing you'll do on the CFDs, by the way. So don't be scared that it's a futures contract. Exact same analysis works on every market as well, right? You can do it with Bitcoin and Ethereum. I might do that if we've got time. This is going to be a long video, right? I think this will be a very long video, actually, but it will be good. It will be good, right? So here's the S&P. Sorry, here's the NASDAQ. NASDAQ takes out the high. S&P also takes out the high. What does that mean? It means S&P and NASDAQ are very bullish. We only want to look for longs. And the Dow is also bullish. This is really interesting here. It's also bullish, but it's not as bullish as NASDAQ and the S&P 500, right? If you can understand that, congratulations, right? So if we look at AUD/USD and NZDUSD, right, really important. You can see prices actually moving up, right? You can see it, right? Prices actually moving up on the weekly chart, right? It is slowly moving up, but GBP/USD and Euro/Dollar are moving up way more, right? They're way stronger, right? So overall, you would say, let's say you looked at this point here, you would say, well, actually, it has gone up. It is bullish, but it's not as strong as Euro/Dollar and GBP/USD. Similarly, with the Dow, well, it has gone up, but it's not as strong as NASDAQ and the S&P. And you only want to be in the strongest currencies and the weakest currencies. You do not, and this is super important, you do not want to be in the middle ground, right? So what I mean by that, perfect example, right? Dollar yen, where it's kind of strong, but it's also a bit weak. It doesn't take out the low, but it's chopping around. You do not want to be in that because you're going to get chopped up, right? You want to be in currencies that are dropping like a brick or going to the moon, right? Currencies, indices, whatever you want to call it, or whatever you like to trade. Exact same analysis applies. And let's quickly do gold, right? I know everybody loves gold, right? So here's gold, all-time highs, and here's silver, right? Silver obviously being the sister market to gold. And look at silver, right? We're nowhere near all-time highs, right? Overall, nowhere near all-time highs, right? Look at the difference. I mean, I'm not even sure what high it would be. Probably this one. Look at the difference. So what does this mean, right? What does this really mean? It means gold overall is a lot stronger than silver. So we want to look for longs in gold. We want to look for shorts in silver if the setup presents itself, right? But like I said, overall, we are bullish. Silver will be dragged up slowly, lethargically. And we've all been in trades like this. Price will slowly grind up, slowly come up, take out your stop loss, slowly move up. You do not want to be in these trades, right? You do not want to be in these trades, right? You do not want to be in any of those trades. You want to be in the strongest currencies, and you want to be in setup start. As soon as you get tagged in, it goes straight to take profit, right? And you've probably been in both, right? If you've been trading for any length, any length of period or time, right? You've been in both setups where it consolidates for ages, hits your stop loss, it does nothing, and then trades where as soon as you get in, it just goes straight to take profit, and it smashes right through take profit. And it's because you're in a strong currency and a weak currency. And while we're here, let's just do Bitcoin and Ethereum, right? I don't really look at this too much, so I think that right there is all-time highs. Here's Bitcoin. Here's Ethereum, right? See, I mean, you can see me literally, this is what I do on a day-to-day basis, right? I'm not making this up. So here we go. Here's Ethereum. What does this mean? In fact, this is choppy and a lot more weaker, right, than Bitcoin, right? So Bitcoin, obviously look for longs. It's the strongest out of all the crypto coins. Ethereum, no, right? No. I mean, you can look for shorts if the setup presents itself, but overall, what do we have? A very, very choppy market. Okay, so the next thing we do, and can you just notice, right? Like, I mean, that took about 15 minutes, but can you see how right away we know that euro dollar GBP, very strong. Obviously, we want to short AUD, NZD. Same thing with indices, same thing with gold. We've learned so much just by using the weekly chart, right? Like, we already know what we want to do. But what every trader needs to do, doesn't matter whether you trade Bitcoin, indices, gold, especially if you trade gold or forex, everyone needs to be looking at the dollar, right? If you're not looking at the dollar, you're blind, right? And it might sound harsh, but the reality is, the US is still, the number one economy in the world. What their market does will affect every single market in the world, right? And we'll talk about this later on, especially when we get into forex. But dollar is seen when the dollar starts to drop, gold will go up massively, right? People will move their money away from dollar into gold, right? Because gold is seen as the store value. But anyway, here we are on dollar, and most people use Dixie, and I use this for a long time. But instead, what I've found is if you type in DX, you should get this US dollar index futures. Now, don't worry, you don't have to pay for the data or anything. What it does is this shows you a lot more gaps in price action, and this is as close to the real price of dollar that we can get, right? So, and for those who don't know, the dollar index is just a dollar against all the major currencies. So it's essentially how strong or weak is the dollar, right? But anyway, here we are on the dollar, and like I said, first thing I like to do, what's the most recent trend, right? Clearly bearish, right? But where are we actually going to? So if you remember in one of the previous videos, I'm not sure which one it was, right? Price was, so can you see this gap right here? This is really important. This is actually a volume imbalance. So you can see my analysis here. Just remove this. This right here is a volume imbalance. This is like a super fair value gap. It's like a really strong fair value gap. So the gap, see how these wicks are covering each other, but there's no like bodies. Right, this gap here is a volume imbalance. Now I think there's loads of different names for it, so don't worry about the name. The name's not important at all, right? It's all about the logic. And I mean, look at this. I mean, almost beautiful, isn't it? It's beautiful how it fills the whole thing up. And if you remember in the last video, I think, not the last video, but a few videos ago, we were at this point in price action, right? We were at this point in price action. I did mention, right, not to brag, but I did mention that I think we were going to fill this entire volume balance because price loves to fill in these gaps. So anyway, what that just tells us is that price, or at least dollar, is bearish. So for me, I like to always have a target in mind for price action. I always like to see, okay, where could price realistically, sensibly go next? And my eyes instantly, and you will get this too with trading, right? You see this? You see how we base? So this is the same thing here, right? We have a volume imbalance. We also have another little mess of a volume imbalance. It's almost like 3 candles forming it. But this right here is what I'm more interested in. This right here, right? So let's just zoom out of the chart. Zoom all the way out. Where are we now? So here we go. So this volume imbalance here is the next magnet for price, right? So it'll essentially pull price towards it, unless of course something crazy happens, or a war, whatever happens, right? And price shoots off in the other direction. But this is our next logical target for price, right? So if the dollar, and this is really important, this is the most important part of the whole dollar analysis, right? If the dollar is bearish, what does that mean for euro dollar? And just look at this right here, right? We have euro against the US dollar. Most people trade forex, they have no idea what forex even is. You have the euro against the US dollar, 2 currencies pegged against each other. So what that means is, let's just think about it. If you've got the euro and dollar's weak, right? Like we can see right here in the charts, dollar is weak and dollar's dropping. What does that mean for euro dollar? Think about it. If the dollar's dropping, what does that mean for euro USD? Is it going to go up? Is it going to go down? Or is it going to do nothing? Right, it's going to go up. Right, it's going to go up because the dollar is dropping. So if we get euro dollar up, it's going up massively. Right? Similarly with GBP USD, because we have USD as the other pair that it's paired against. Right? Similarly with euro dollar, right, literally euro against the dollar. And because the dollar's weak, euro is going to go up. Similarly, I said similarly quite a lot, haven't I? I need to change my vocabulary up. But here we go, right? GBP USD, dollar's weak, GBP shoots up. And then this is the really important part. Do you know how I said AUD, USD is very weak? And it is. Just look at it overall, right? Just dropping massively. because the dollar is weak and it's dropping, so let's just get this up. Because the dollar, like we said, is dropping, what that means is that AUD/USD, even though the Australian dollar itself, so this Australian dollar, the actual country and its currency, is very weak and dropping massively, the dollar is a lot more weaker, or at least relative to the Australian dollar, the dollar is a lot more weaker. So AUD/USD will be dragged up, right? Because both currencies are weak, but the US dollar is a lot more weaker. Not a lot more, but it's just a bit more weaker than AUD/USD. This is why we get this slow, little lethargic, choppy bit of price moving up, right? That's why we get that, because the Australian dollar itself is bearish, right? But the US dollar is even more bearish, so it slowly drags it up. Same thing with NZDUSD, right? That's why price is slowly moving up. And we'll talk more about this when we get onto the lower time frames. But I mean, you can see, right? I can be here literally for hours and hours and hours explaining daily bias, right? But really important. And if you understood that, how the Australian dollar is bearish, but the US dollar is even more bearish, that's why we're slowly dragging up. Congratulations, because I don't think trading gets any more difficult than that. Now, we essentially have our daily bias, right? All that analysis we've done has already told us our daily bias. But, you know, it's not enough just to blindly follow the weekly chart, although the analysis here stands, right? We are super bullish on euro dollar. We want to look for longs and we want to look for shorts here. And same thing with all the other markets. What we really want to see on the lower time frames is two things. We want to see confirmation and we want to see targets, right? Like liquidity targets. So what we're going to do now on euro dollar is let's just remove this. We're going to get onto the daily chart and see what we can see. And what we really want to see is just a similar sort of thing, right? We want to see more confirmation. And you can just look at it, right? So let's just look at the daily charts. Let's just go through each, actually, because I think that'll make it a lot more easier, right? So here's the daily chart. I mean, bloody hell, right? Look how obvious this is. Let's just clean all these charts up, right? So here's the daily chart for euro dollar, and we can see we've got order blocks down here. We've got this fair value gap. Price comes up, respects, I guess you would say, this order block here. I know you've got this little doji thing here, and shoots right off. Right, this is what we have on the daily chart. Similarly, GBP/USD, right? I mean, look at the little, there's literally no retracement whatsoever. Price shoots right off, right? AUD/USD, I mean, awful, absolutely awful. Now, this is news. I think this is news on the dollar, right? So dollar drops massively. AUD/USD is forced up. And then look how weak this is. Look how weak this is. You do not even want to be trading this whatsoever. Maybe, you know, you can look for shorts, but you do not want to be going long in this. Who wants to be going long in this, right? This is the definition of low probability trading, right? This mess right here. NZDUSD, bit more. I mean, if you look at AUD, what do you got? AUD/USD and NZDUSD. New Zealand dollar is slightly more bullish, but really, like, that does not mean to trade it. That does not mean to trade it. So here's NZDUSD, right? Now you can tell a lot by just looking at this daily chart. So we know from the weekly analysis, which is the most, you know how I said the weekly chart is the most important time frame right at the beginning of the video. That's why it's the most important, because we can learn so much just from the weekly chart. But here's a little, I mean, I say a little, here's another golden nugget. I mean, giving you a lot of gems right here. But when you're doing daily buys and you've got your overall direction, something that's really interesting, something you really want to look for is obviously the most recent price action now. Because now that we've got our overall macro analysis on the weekly chart, we're looking more, we're thinking more about possible targets and entries, right? That's what, you know, we're thinking about now. So here we are on the daily chart, and can you see this most recent price swing right here? Can you see how there's lots of fair value gaps, right? Okay, well, let's go through GBP/USD, and then I can explain the key point here, right? Fair value gap here. There's actually a little baby fair value gap here, and there's another fair value gap here. AUD/USD, there's a little one here, but can you see how there's a lack of fair value gaps, right? Similarly, NZDUSD, lack of fair value gaps. There's one here, but look at all the lack of fair value gaps. This right here is another gem that I'm going to give you, right? If there's a lack of fair value gaps, price will consolidate. Right, that is the definition of consolidation. A lack of fair value gaps implies consolidation, choppiness, there's no strength, there's no direction in price, right? Where look at euro dollar, strong, aggressive, obviously let's just zoom in a bit more, strong, aggressive fair value gaps on the daily chart, not the 5 minute, on the daily chart, right? Similarly with GBP/USD, strong, aggressive fair value gaps. AUD/USD, lack of fair value gaps in this mess, right? NZDUSD. So when you've got strong, big fair value gaps, that just adds to the probability. Now, what does this mean, right? This analysis we've done on the daily chart, it essentially confirms what we saw on the weekly chart. And do you know how I said the weekly chart essentially tells you everything? The only reason we look at the daily chart really, in my opinion, it's just for confirmation. That's the only reason we really look for it, is confirmation. And big, strong fair value gaps is our confirmation, right? And then AUD/USD, the lack of it here, right? So this is our confirmation. This is a weak market. We want to look for shorts or avoid it at all. And then this is our confirmation at GBP/USD. And euro dollar is very strong. Now, what do we do with this analysis? All we need now is our targets. We know that euro dollar, we know all the markets we've analyzed. We know their direction. We know the strongest ones. We know the weakest ones. We know the ones we want to avoid. All we need now is our targets, right? And I'm going to show you it just on a few currencies. Otherwise, we'll be here literally forever, right? What we're going to do now is, actually, let's get the 4-hour chart, because people are going to ask about the 4-hour chart. What I like to do on the 4-hour chart is I like to look for liquidity. Now, if we zoom out, there's literally no liquidity that I can see on the 4-hour chart, which is why, this is, again, submit for your notes. If you can't find liquidity on the 4-hour chart, you want to go to the daily and then the weekly, or just go to the weekly chart, because, like I said, the weekly chart is probably the most important time frame in trading. But here we are, right? So here's the 4-hour chart. If you're a day trader or scalper, here's your easy target. Easy target. Look for any sell, any liquidity sweep. So let's imagine you've got your liquidity sweep here. Price takes out a low, shoots off, fair value gaps, order blocks, Fibonacci, whatever you like, VWAP, ride price off, right? If you're a day trader, scalper, you're looking for this exact setup on the 5-minute, 1-minute, 15-minute chart, whatever you trade. Let's get GBP/USD up. Similarly, this is your liquidity target. AUD/USD, if you really want to go long, which you shouldn't, right? This would be your target, but price will not even get to that. So I would just avoid this. If you wanted to go short, however, if dollar for whatever reason was going up, this would be your target right here. And similarly, NZDUSD, which, at this point right here in price section, because it's slightly more bullish than AUD/USD, I'll probably take out this high. But again, you do not want to go long in this, right? This is a mess. Just look at it, right? Complete mess in price section. And you can do the exact same thing with all markets, right? So that right here gives you your easy liquidity objective. If you're a scalper or a day trader. I'm just going to give you one more nugget before we end the video. We want to look for the overall direction of the market, because this liquidity is not that important. It is fairly important, but the real liquidity is if we go on the higher time frames and look at the overall analysis, right? What is price likely to do next, right? In euro dollar, what is it likely to do next? We know we're bullish. We've just taken out this high here. In fact, let me do something that will help us out. Let's get the horizontal line and put it here. Right, now let's look to the left-hand side of the chart and see what we can see. Now, can you see anything that's a bit interesting around here? Hopefully, because I'm pointing right at it. See this big bearish fair value gap? You just move it up a bit, right? This big bearish fair value gap. This right here, in my opinion, is the next likely place for price to go, right? I think I did mention this in the last video. I'm not sure if I did actually, but you can see price literally beautifully, almost beautifully taps here, right? So for me, because we're bullish on euro dollar, what I'd like to see is us fill this fair value gap, right? This weekly fair value gap. And if we break for it, and by break for it, I mean wick or, body closes for it, and we've got these highs here, and we've got this fair value gap here, right? But that's an if-then statement. If this happens, then. But for me, this big fair value gap is our next draw on liquidity. This is our next direction for the market. You know how I said with the volume imbalance, this is also going to act as a magnet pulling price towards it. Not as strong as a volume imbalance, but still pretty good. I mean, you can see here, right? Here's another volume imbalance. That price perfectly fills up, right? So let's mark this out. Like that, right? Beautiful. I mean, literally fills it up exactly and then drops. Price really likes to fill in those volume imbalances. But let's get GBP/USD up. For GBP/USD, have we taken out this high? Yeah, we have, right? So for me, this is our next high. And in fact, this is my favorite pair, by the way. Absolutely love this pair. And again, here's another important. So that's really important in price, actually. Can you see these big numbers here? 1.38, 1.4, 1.39, 1.36, 1.35. These are big numbers. And when smart money and big banks get into and out of their positions, they do it at key numbers just so it's easy to get their orders filled. And they're not going to buy at this price here, like 136.95 or 49, right? They're not going to do that. They're going to buy at major levels. So at these levels right here, like 1.38, you guys get the point, right? I mean, you guys get the point, right? 1.38 at that level right there. there will be lots of inbuilt liquidity, right? And what I mean by that is there will be lots of banks and institutions, once that level gets hit, they will start buying or they'll start selling. Right? They'll start buying GBP USD because they think it's going to hit 1.4, or they'll start shorting because they think that GBP is overvalued, right? Or invested, right? I mean, it might sound crazy, but there are people and big banks who invest in currencies. They might want to get into a position or get out of that position. So there's lots of liquidity at this level, and you won't hear that anywhere. You're not going to hear that anywhere, are you? That took a lot of years of experience and some insider knowledge to figure that out. But anyway, this is our next draw on liquidity for GBP USD. This 1.38 level, and then this level here. What am I doing? This level right here, which is that big level on the weekly. Oh, we can see it on maybe still on the weekly chart. This level right here. Right. Next draw on liquidity. These are our next logical targets. Right. So we know we're strong on GBP USD. We want to look for our targets. These are our next logical targets. So AUD USD, I mean, like we said, you do not want to be trading this at all. Like, again, you can just look at it and think, oh, like, I don't really know where price is going to go. Yeah, exactly. Like, there's no logical targets because it's a choppy market. We want to avoid, right? Big eggs for this market. Again, NZDUSD, there is a volume imbalance here. Let's just remove this. Sure, price has filled it. Just tapped it a bit. Price is likely to fill up this volume imbalance, but that does not mean that you should go long. It means price will slowly, lethargically, grind its way up, taking out your stop loss, and slowly work its way up, and then fill this fair value gap. You do not want to be in this trade whatsoever. So that right there is how you get your targets. So let's just go through all the markets because I know what people are like. They're going to want to know. So this low right here is likely to be taken out next on dollar CAD, even though dollar Swissy is obviously a lot more bearish. This low will eventually be taken out, right? Because there's no respect of any order block. Look at this fair value gap, this bullish fair value gap. Price just smashes right through. This will be our next logical target, but like I said, it will grind down, right? And then dollar Swissy. This, I mean, look at this. Just remove this. This wick all the way down here on this news event is our next target. But to be honest, it's so far away. So for me, I'd look at big figures on the side. So we've just broke down at 0.8, 0.79. It's the big. I guess is our next target. I mean, look at that, beautiful. But you can expect a retracement, and this is again another golden nugget, right? This is why I like making these longer videos, because I guess all my wisdom of trading comes out, right? If price is taken out a major liquidity pool, which let's just zoom out. It was actually this liquidity pool. There was equal lows and price drops massively. If it's taken out a major liquidity pool, price will start to retrace back, just to generate more liquidity. It's essentially done the damage, so they need to make more liquidity. Because let's be honest, like the next major stop loss orders are down here. There's not really much. There's no liquidity for smart money to target. So you can expect prices, slowly retrace up, fooling traders, and then price will drop down. And you can take out these lows, and you can see that here, right? Where we're generating liquidity at this low here. At this low, let's zoom out. Nobody's got their stop loss. Very few people have it because they know that the Swiss franc's bullish, bearish long term. Sorry, dollar Swissy's bearish long term. So price comes down, gives the illusion of equal lows, then goes off. People are, oh yeah, safe stop loss area. Price quickly and aggressively drops down and to take out their stop loss orders. Just it moves very fast, so they can't move their orders. But these markets, like I say, are highly manipulated. Highly manipulated. Anyway, that's dollar Swissy. Dollar yen. I like to see it take out this low. We filled in this volume imbalance. I like to see us take out this low, which could be a target. By low, I mean these lows, all these lows right here. But again, like I said, does that mean you should be trading it? No, but if price is down here, you may as well target it. And let's get S&P up. This is really important, right? If you're at all-time highs, I like to wait for a retracement. So let me make this very clear. Like, I don't just buy, there's no liquidity like target. So what I like to see is I want to see price drop, and then let's say price drops and it leaves like a swing high. Imagine this doji is like the swing high. Then you can ride price up and target that high, right? But I don't like to just buy randomly, hoping that price hits some imaginary number, right? Because that's almost like gambling at that point. Similarly with NASDAQ, there's no target. With Dow, let's get the weekly chart up. Get the weekly chart up like this. I'd like to see us make. I mean, I don't know if we'll take all-time highs out on Dow because it looks pretty weak compared to the other two. I'd like to see this high get taken out. Right, we could do something similar to this where we like kind of just wick really high up and then maybe chop and then drop. Who knows what could happen? But like I said, low probability. You do not want to be trading this. And let's get gold up. Everyone loves gold, don't they? So I actually made a separate video, which is on screen now. The previous video I made, which is why I'm still bullish on gold. It's going to take it literally takes a whole video to explain it, right? But make sure you watch that video. Essentially, what's happening is, let's get the 4-hour chart up. So gold's at all-time highs, right? Remember we did the analysis. There's no other liquidity pool here. Gold is at all-time highs. It's just a bit below it, so we do have a bit of a target. What's really going on here is price is essentially, so we've got liquidity here, all-time highs. This liquidity pool was taken out here. What's really happening is price is just going down so it can go up, right? It's going down to give smart money traders a nice place to buy, right? And again, if you remember the volume imbalance I talk about, this right here is your volume imbalance, like that, right? So I'd like to see price do something like this. Take out this liquidity pool here into this volume imbalance and then shoot off. Price is essentially going down to give smart money traders a discount, and then they can buy it cheap, right? And a good way, or the only way they determine that, is by getting the Fibonacci from the low to the high. And below the 50% level is seen as cheap. And you can already tell with all these wicks and dojis that smart money's starting to buy, right? Starting to buy. I hope that makes sense. Very complicated analysis, but it is what it is. And if you want to learn more about gold, there's a full video on screen now that you can check out. But silver, what do I think for silver? Let's get the weekly chart up. Flipping out, what's going on here? Let's get the weekly chart up. This is our next high right here. You know, I'm actually going to do something that I don't normally do. I'm going to get the monthly chart up just so it's more obvious. Right, monthly chart. Every single high, this is, again, it's for your notes. Every single high on the monthly chart and low, there is so much liquidity, right? It's a whole month worth of trading. This is our next key liquidity pool for silver. So silver, it's almost right there, right? So if you're a day, let's get the 4-hour chart up now. If you're a day trader or scalper, you look for your entries there. But like I said, you want to be in gold, you don't want to be in silver. Just wait for gold to take out whatever liquidity or even this volume balance. You can even ride price down to this level and then obviously ride the reversal, right? And then last but not least, let's just do Bitcoin, right? 'Cause I know so many people love Bitcoin. Here we are on the 4-hour chart. This high right here, this high, this high, this high. I think Bitcoin's going to all-time highs. Again, I made another video, you can see on screen now, why I still think Bitcoin's bullish. And you know how I said these markets go down to go up, and they go up to go down? What's really happening here? Bitcoin's bullish. They're generating liquidity. They take out the liquidity, and they can ride price off. Again, all markets, including crypto, highly manipulated and only move for liquidity. And for Ethereum, I expect nothing. I expect chop. In fact, I'd like to see these fair value gaps here be filled. Just price touch it again. Yeah, nothing to see here. But that is right there is how you do daily buys, weekly analysis, top-down analysis, whatever you want to call it. It's all the exact same thing, which is getting the direction of the market, the overall direction of the market, right? And if you do that, and if you understood that, congratulations. Okay, so the first thing you want to do is you actually don't want to look at Dixie. Instead, you want to come onto TradingView and you want to type in DX, and it should give you the US dollar index futures, right? This is what we want to look at DX on TradingView. Now, what this is the currency futures for the dollar index. This is what smart money is looking at, right? And this is as close to the real price action or the real price of the dollar that we can get. And also, it shows a lot more gaps, right, in price action that the CFDs don't show, right? But all we need to do is we just need to get onto the weekly chart and we just need to look for the overall most recent trend, right? What is the dollar doing? Because the reality is there's only three things that it can do. It can either be bullish, it can be bearish, or it could just consolidate. And hopefully, and remember for the weekly chart, right, we don't care about all this price action, right? We don't care about, you know, this order block all the way over here. We do not care about that. All we care about is the most recent bit, the most recent price swing, whatever you want to call it, and what has price actually done. And it's pretty obvious, or at least hopefully pretty obvious, right? Price has been bearish, right? Massively bearish. And if you watched a previous video that we did, you see these gaps here. Just make this clear. You see these big gaps, which is really a volume imbalance, right? See these big gaps in price action where there's only wicks covering each other, right? Like that. This is what the currency future, this is what DX shows that Dixie doesn't show. And for those who don't know, Dixie is just a CFD version. And even if you trade CFDs, you want to be looking at this. But these gaps here in price action is what I was talking about in the previous video on like daily bias. And can you see how price literally beautifully fills it up and then starts to reverse? Now, overall, the dollar is still bearish. And all we need to know when we're looking at the dollar is the overall direction, right? And clearly, as we've said, the dollar is bearish. Now we don't need to get onto the 5-minute chart or 15-minute chart. We just want to look at the overall trend, and we can get the daily chart up just to see what price is likely to do. Right, so let's just delete all these gaps here. If we look at a daily chart, what's likely to happen? In fact, let's get the 4-hour chart up, because the 4-hour chart is the highest time frame you want to use. Now that might sound like insane, but it shows a lot more gaps, right? And the way price price actually moves in all markets is it does not move in straight lines, right? Price does not move in straight lines, even if it's bearish, right? If it's bearish, it's going to come up like that, right? So all we need to know is the overall trend. But it's also really important just to look at gaps in price action to see what price is likely to do next, right? Because this will help us when we talk about euro, dollar, gold, Bitcoin, all the other markets. This will really help us, right? So we know dollar on the weekly chart's bearish overall, and we know, or at least see this gap here, very likely that price is going to touch it, fill it, and then continue downwards, right? So any retracement up, any bullish movement on the dollar is very low probability, right? So let's just remove all this. We've literally got all we need from the dollar, which is, let's go on the weekly chart, is overall, it's bearish, right? Overall, dollar is bearish. So this is really important. Now that we've got our analysis with the dollar, let's go and move on to other markets, right? So let's go look at euro dollar. Let's just get the chart right away. So remember, bearish on dollar. Let's just think, what do you think will happen to euro dollar? It's the euro against the US dollar. Let's think here, right? If you have the euro and you've got the US dollar and the US dollar is dropping, what do you think will happen to euro dollar? Will it go up? Will it consolidate? Or will it go down? Right? Let's get it up. Massively bullish, right? Now the reason why it's massively bullish, and this is so important, so many forex traders don't even understand what forex actually is. You're not trading the euro, right? You're not trading the euro. You're trading the euro against the US dollar. You've got the euro, which is obviously what the EU uses, right? And then you've got the US dollar, the American currency, which we just looked at in price action, DXY or DX, and the futures contract. We have euro and we have dollar, right? And the dollar is bearish, so it dropped massively. What that means is the euro is going to go up. And look at this massive explosion in price action in euro dollar, because the dollar is bearish. So let's get the dollar up again. This is DXY, but basically the same thing. Dollar drops massively. Look at euro dollar. Right, let's look at euro dollar. Huge explosion in euro dollar. Now let's go look at gold, right? And we'll see the exact same thing here. What actually is gold? Now when I say gold, I mean XAUUSD, right? You can trade XAU, I guess what would it be, against the euro and stuff. But most traders, we're trading gold against the US dollar, right? But think about that. What does that really mean? Gold against DX or DXY, whatever you want to call it. Gold against the US dollar. If the US dollar is bearish and dropping, what does that mean for gold? It means it's going to go up, right? It means it's going to go up. So it means, and this is the key takeaway of the video, the highest probability setups will be going long in gold, going long in euro dollar, going long in the other markets that we'll talk about. But really, really important that you understand that, right? For forex, you're trading essentially two pairs, right? That's why we call it pairs. In this case, we're trading gold, the actual commodity, against the US dollar. If the US dollar is dropping, gold will explode, right, in price, and that's what we've seen here. Also, and this is like fundamentals, but you don't really need to know this. When the dollar drops, gold is seen as a safe haven, right? Because there's lots of rich Americans, right? There's lots of rich Americans, and they're not going to keep their money. If you're a millionaire and billionaire, you're not going to keep your money in dollar, let's say. You've got 100 million, you've sold your company. You're not going to keep, let's say you've sold it around here, you're not going to keep 100 million in US dollars just to watch price drop 20%, and then you lose, what, 20 million in, like, how many weeks is this? What's this, like, within 6 months? Like, you're not going to do that. You're never, ever going to do that. So gold is seen as a safe haven. So that's why gold has exploded. So if we look at the other currencies here, and this is really important here. So GBP, you can see my analysis. Let's just clean these charts up. So we've got euro dollar, really, really bullish. We've got GBP USD, also really bullish. We've got AUD USD, which is also bullish, but we'll talk about this in a second. We've got NZDUSD here, right? So remember, dollar is bearish in all cases, right? The US dollar is always dropping for all currencies. But what we really have here, this is super important. If you understand this, this is as hard as trading can ever get. So we've got GBP USD, really bullish. Look at this high here, how we take it out. Euro dollar, also really bullish, takes out this high. NZDUSD, Really choppy, and I'll explain why in a second. Does not get anywhere close to taking out this high. Sorry, that was AUDUSD, and similarly with NZDUSD. Both of these pairs are very, very weak. Now, what's actually going on, and this is super important, is you have the New Zealand dollar itself, which is also very bearish, and you've got the US dollar, which is also bearish, right, like we talked about. So in this case, the New Zealand dollar is slightly more bullish compared to the US dollar, which is why it slowly, lethargically moves up, right? But as traders, what this means is you do not want to be trading this. You do not want to be trading a weak pair, a weak currency, New Zealand dollar against another weak currency, because you're going to get chopped, right? And if it's chopping on the weekly chart, it's going to chop on the 5 minute, 15 minute, 1 minute, any time frame you trade, it's going to chop, right? When people say price is fractal, that's exactly what they're talking about. Similarly, AUD/USD, you've got a weak Australian dollar against the US dollar, right? Both of these are very weak, but in this case, the Australian dollar is slightly more bullish. Yeah, all right. I was thinking, okay, should I say this or not? I'll give you guys a real golden nugget here, right? So this is, you better like and subscribe, right? This is advanced. This is really advanced stuff here. This is the real source as well. So if you type in 6B, you will get the currency futures. So 6B will give you the British pound. 6E will give you the euro futures. 6A will give you the Australian dollar futures. 6N will give you the New Zealand dollar futures. And you can see my analysis, right? Again, I'm not making this up. This is what I do on a day-to-day basis. This shows, right? Do you know how we did the dollar, right? Now, I know we did DX, but essentially it's the same thing. This shows how strong or weak the dollar is. This right here shows how strong or weak the New Zealand dollar is. Similarly, Australian dollar, euro dollar, and the pound itself, right? So, sorry, this shows the actual currency itself. So we've got the pound here, really bullish. We've got the euro itself, really bullish. And then we've got the Australian dollar itself, which is really bearish, does not take out this high. And similarly, the New Zealand dollar, which does not take out this high, right? So we've got two weak currencies, and the dollar's also weak. And then we've got two really strong currencies, right? So you can just mix and match if you're a swing trader, or, you know, let's get yen up actually, right? Yen too, also very bearish. So what that means, if GBP, let's say the pound itself is very bullish, it means GBP, JPY will also overall be really bullish. So what this means is we can just quickly look at the futures contract, New Zealand dollar, see right away that it's weak, see that the Australian dollar is weak, see that euro is strong, and that the pound is strong. And then we can quickly and easily just go and look at the crosses, right? So euro dollar, we know that this is very bullish. GBP is going to be bullish. NZDUSD is bearish. AUDUSD is also bearish. Okay, so what does this really mean as traders? This is the golden nugget, the key takeaway. This is what you want to write down, right? Because the dollar's bearish, the highest probability will be going long, right? In all four of these currencies. Now, because the Australian dollar is also very bearish, you do not want to trade this, right? Big X through this, right? Similarly, big X through this pair. We do not want to be trading this at all. You've got a weak currency against a weaker currency. You're going to get chopped. You're going to get bad price action. You're going to short this, or even, let's say, go long, right? Because we're bullish. Overall, you're going to go long. You're probably going to wait for a liquidity sweep. Let's say this is a stop run. Price shoots off. There's a fair value gap that you enter on. And price will still take out your stop loss, or it will just chop for ages and not do anything because you're in a weak currency, right? Against another weak currency. So ditch these two. Focus on GBP and euro dollar, right? And what will happen, and these are the setups that you enter, where let's say there's a liquidity sweep, price shoots off, you enter on, let's say, a fair value gap, whatever you like to enter on, and price just instantly shoots off to take profit, right? Let's be honest, you've had that trade before, right? Where price just hits your entry, instantly goes to take profit. Those are amazing trades, right? And it's not an amazing trade, like, oh, I got really lucky. This is what's happening, right? You're going long in a very strong currency, the euro, against a weak currency, the dollar. And as soon as you get tagged, price just shoots off. I'm not going to talk more about entries in this video, but if you want to learn more, go check out this video on screen where I talk about the golden entry, right? Liquidity sweeps, buyers sweep, entry, all that good stuff. So one last thing I guess I would want to talk about, or just overall, is indices. So for those who trade indices, the dollar is bearish, right? So obviously we know the dollar is bearish. But the S&P 500, right, is also very bullish. Now, you might be wondering, okay, Atif, what's going on here, right? Because this isn't pegged. This isn't the S&P against the dollar, right? This is the top 500 companies in the US, right? But really important that you understand, when the dollar drops, the S&P 500 goes up, right? Now, the reason for that is, let me think about this. So those who don't know, I'm actually a qualified like investment and trading advisor in the UK. In a lifetime ago when I worked at a bank, that's what I used to do. But if I remember correctly, so don't quote me on this, I'm pretty sure this is how it works. When the dollar drops, all of the American companies, because you've got to think about it, if the dollar drops, that means it's easier for everyone who's outside the US to buy American goods. Think about it, right? So if the price of the dollar goes down, and the iPhone's worth $1,000, that means relative to euro dollar, GBP USD, it's actually a lot cheaper for Europeans, people in the UK, Australians to buy it. And then that means that American companies do a lot more business globally. And then obviously if they're doing a lot more business and they're making more money, they've got more profits, their stock price goes up, S&P goes up. I'm pretty sure that's how it works. A weak dollar means that it's cheaper for everyone else across the whole world to buy, and then these companies make more money and the S&P 500 goes up. I'm pretty sure that's how it works. Don't quote me on that. You don't need to know that at all, right? It's not, you're not going to get an exam on it. All you need to know, dollar goes down, S&P is going to go up. And similarly, S&P 500 goes up, NASDAQ's going to be dragged up with it, and Dow's also going to be dragged up with it. Again, can you see how Dow hasn't taken out this high here, whereas NASDAQ and S&P has? Similarly to how euro dollar's taken out that high, Australian dollar hasn't. What that means is you don't want to look for longs in Dow. And I know some of you love the Dow. The better trade for now is in NASDAQ, is in S&P. Similarly, if we get gold up, gold really bullish, silver, look at this, still not taking out all-time highs, right? So just something that you want to focus on. And while I'm here, I may as well talk about Bitcoin, right? BTC, this is, what's this? BTC USD, Bitcoin against the US dollar. So if the dollar is dropping, what's going to happen to Bitcoin, right? The only reason this wouldn't work, the only reason price wouldn't go up is if the Bitcoin itself was incredibly bearish, right? Because there's three things that can happen. If the dollar just drops and Bitcoin's just a normal currency, or even if Bitcoin's choppy, is it will just shoot off, right? The only way this will not happen is, like I said, if the Bitcoin itself was very bearish and the dollar was bearish, then it would just chop for ages, right? Like that, right? But obviously we don't have this here. So dollar drops, Bitcoin bullish. Obviously if Bitcoin's bullish, all the other cryptos will get dragged up with it. So dollar drops, Bitcoin's bullish, gold is bullish. Only look for longs. This is the key takeaway. Do not start shorting gold, especially at all-time highs, or basically right at all-time highs, right? Only look for longs. The highest probability setups be long in gold, long in Bitcoin, long in the S&P, any other indices, going long in euro. And just by doing our analysis, just by looking at the dollar and not even going below the weekly chart, we know right away to avoid this, trade these two, right? And we know exactly what to trade, right? This is how you do real analysis. No, you don't even have to do top-down analysis. The weekly chart literally tells you everything. Okay, so liquidity is simply stop-loss orders, and the only reason these markets move is for liquidity. Now, the reason why that is because it allows smart money, big banks, big hedge funds to get in and out of their positions, because where there are stop-loss orders, there's going to be money. So to determine liquidity, what we do is we get on the 4-hour chart. Now, you can use the daily, the weekly, and even the monthly, but to be honest, just use the 4-hour chart. We have to use a higher time frame because that gives us the overall direction of the market, or a bird's eye perspective, if you would like. But you get onto the 4-hour chart, and what you do is you simply ask yourself which major high or low is price most likely to go for. So right now in price action, we're at this point here. So you're going to ask yourself, right, you're going to look to the left hand side of the chart. Is price more likely to come up and take out this high here, where there's lots of stop loss orders at, this high here, or is price more likely to do this? Is it more likely at this point right here to come all the way down and take out this major low here, right? Which one is more likely? Hopefully it's pretty obvious, right, that price is more likely to come up and take out this high right here, or these highs right here, right? Price is right next to it. There's no respect of any bearish order blocks, bearish fair value gaps, right there. So what does that really mean then? What does that really mean? If we're at this point on the charts, we know that price wants to go for these highs here. What does that mean? It means one simple thing. It means we are bullish and the markets overall are bullish. So the highest probability trades are going to be looking for longs. Now at this point here, we get onto the lower time frames, or our entry time frames. A liquidity sweep is simply a stop run. It's a fake move in the opposite direction of the market designed purely to take out stop loss orders. And you will see this in every single market, in every single session, because the highest probability trades always occur after a liquidity sweep. So what actually is a sweep? So can you see this bit of price action right here? So we've got this point here, which is essentially end of Asia, beginning of London's low. Price shoots off massively. Now, when it shoots off massively, lots of people are going to start putting their stop loss orders at this low here because they're going to think it's very nice and safe because it's a major sessions low. And then can you see, this is really important here, can you see how price consolidates or accumulates for a bit? You might hear ICT say accumulate. And then look at this point here, right? Where does price go here? It drops massively, but it doesn't drop to any random point. It drops all the way down just below this low here where there's lots of liquidity, instantly shoots off in the opposite direction, gives smart money traders their entry, and then goes in the opposite direction, taking out liquidity. And you will see this over and over and over again in every single market. And it's insane how high probability this setup is. And the reason why it's so high probability is because liquidity is taken out at this low here, right? So this fake move here, right here, is a stop run. It takes out stop loss orders. So any entry after a stop run, after stops have been raided, is super high probability. Okay, so how do we actually make money with liquidity sweeps? What do we actually look for? So if we just explain this in more detail, this right here is the fake move, right? This is a fake move which causes our liquidity sweep. So this blue line here, this dark blue line, this is where the old low is, right? So this is Asia and London's low. Lots of liquidity at this major low here because price shut off. Lots of people think that this low is nice and safe. Price at this point here, so this is Dow, right? So this is indices. So at 9:30 a.m. open, our fake move starts, right? So you'll always find this with indices. At 9:30 a.m. there will always be a fake move. Now, if you trade forex at 8:30 a.m. whenever there's news release, there will always be a fake move. So if you want to trade news on forex, this exact same thing will apply, right? So the moment the indices open or the news announcement, there will always be a fake move designed to take out liquidity, right? It will always be a liquidity sweep. So price instantly at 9:30 a.m. drops, takes out this low here, right? Takes out this low here. So this light blue line, or this dark blue line is the low. It takes out the low and then instantly shoots off in the opposite direction. Now this is really, really important here, so pay attention, right? So once we go below this dark blue line, right? I don't know it's a liquidity sweep, right? I have no idea whether price wants to just continue to drop massively or whether it's going to start to reverse. I have no idea, so I need to wait for confirmation. Now, there are traders who don't wait for any confirmation. They just buy as soon as price goes below an old low. That's referred to as turtle soup. So you might hear traders talk about that. That's what that really is. I don't trade that. I always wait for confirmation. And the easiest way to wait for confirmation is to wait for a fair value gap to form in the opposite direction of the liquidity sweep. So the moment this bullish fair value gap forms in the opposite direction of this sweep, right? Because remember, this is a fake move, takes out the low. So the moment this bullish fair value gap forms like this is smart money screaming at us that this really is a liquidity sweep. This is really just a fake move designed to take out stop loss orders. That's the only reason price came all the way down to this low and then instantly reverses. It didn't go down to some random point, it only came down to this low here. Okay, so now that we've got our liquidity sweep, all we need now is a simple entry, and literally any entry pattern, any indicator that you like, as long as you've got a sweep, will be high probability. So once we got the sweep, all we need is a simple entry pattern. Now you can take this fair value gap if you really want to, if you like trading fair value gaps. But for me personally, I like order blocks, I like Fibonacci retracements, and in this case, we've got a nice, beautiful order block right here, right? Because if you trade fair value gap, you're gonna have to ask yourself, which one do you take? Ideally you should be taking the lowest one, but in this case you don't even get tagged in, and it's the 1 minute chart too, right? So for me personally, I'm going to take this order block here, this nice juicy order block like this, right? So this is our order block we're going to enter on, and like I said, really does not matter as long as you've got the sweep. Really does not matter wherever you enter, but what does matter is where you put your stop loss. The only reason we wait for a liquidity sweep, this is really important, the only reason we wait for a sweep is so we have a safe place to put our stop loss. So we're going to put our stop loss always at this low here, because this is the low that caused the liquidity sweep, right? Let's just zoom out right here. This is our liquidity. This move right here was a sweep. The only reason we wait for a sweep in the first place is to have a safe place to put our stop loss orders. There is no point whatsoever in putting your stop here or here, because you're going to get wicked out, right? You're going to see price come like this and just wick out your stop loss and then go straight to take profit, right? The only reason we wait for a sweep is so we can have a high probability place of putting our stop loss orders, or our stop loss order at. Right, so if you don't put your stop loss at this low here, there is absolutely no point in waiting for a sweep. You may as well just ditch it. There's no point in doing it. You have to have your stop loss at this low here, because it's very unlikely, because price has come down and taken out liquidity over here. And it's going to go all the way up, come all the way back down, take out your stop loss, and then go straight to take profit, because it's already done that, right? So super unlikely that's going to happen. What is likely to happen is this, right? So you get your high probability retracement, and then for your take profit, you're going to target, for me, I'm going to target minimum 3 risk to reward ratio, right? Minimum 3 to 1. Or if you want to target, if you want like a really good entry, target the opposing liquidity pool, right? Which would be this high right here. So if you're taking out an old low, target the old high, right? So this would be, what's this? London's high, right? So you can target London's high for an easy 4.5 risk to reward ratio. Okay, so the first thing we need to look for in this 3-step formula is the bias, right? Bias is the most important thing, because if you don't have a direction, a likely direction for the market, and you're buying and selling, you are gambling. Now that might sound harsh, but you need to have a bias, and the easiest way to get your bias is to get on the 4-hour chart for whatever market you trade, and essentially just ask yourself at the, at live price action where we are right now, which major high or low is price most likely to go for, right? So at this point right here, right, this is market open. See this green thing here? At this point right here in live price action, when you're on the chart, is price most likely to go for this low? So we've got this low and this low, these equal lows. Or is price most likely, more likely to go for some sort of high all the way up here, right? I don't even know where the most obvious high would be. Hopefully it's pretty obvious. I have marked it out, and I always tend to do this. It's pretty obvious that price wants to go for this low and this low here, right? Where there's relatively equal lows, and more importantly, there's lots of liquidity. There's lots of stop loss orders, because the only reason these markets move is for liquidity, right? And liquidity and stop loss orders are the exact same thing, right? And the reason the markets move for liquidity is because this is where all the money's at, right? Smart money, those with billions, they can't just randomly market buy like me and you can on the 1-minute chart, right? If you've got $5 billion that you want to get into the market, you're only going to do it where there's major stop loss orders, right? Where there's also billions of dollars worth of money resting here. And on GBP USD and any market, you're going to find that on the 4-hour, daily, and weekly. But the 4-hour chart tells you everything that you need to know. So we know, right? We know it's very likely that price is going to come down and take out these lows here, right? This low and this low here. Right away, we have our bias. I don't know how long the video's been currently, maybe a minute long. Within a minute, we have our bias, right? No complicated daily bias, or top-down analysis, or weekly chart. This is the easiest way to get your bias for the market, right? And for those who don't know, bias is simply the direction, right? The highest probability entries are going to be targeting these lows, right? So when we get onto our lower time frames, we're only going to look for shorts, because that's going to be the highest probability entry. So now that we have our bias, we need to get on to step 2 of the process, which is a sweep, right? Bias, sweep, entry. Now to do this, we're going to get onto your entry time frame, which is really important. So let's imagine we like to trade the 5-minute chart. What we're going to do now is we're going to look for a sweep. So right, this blue line here is the 4-hour liquidity that we were just talking about, right? Now what we want to see, right, it's not good enough to just enter blindly, right? What is it? Buy low, sell high, buy low. It's not good enough to just do this, right? And if you've been trading for any length of time, you know this is not what happens, right? Trading is not that easy, right? Trading is not that easy. What usually tends to happen, and this is probably happened to you before, right? Is let's imagine we've got some high, price goes just above this high, enough to take out your stop loss, then goes up in the opposite direction, then gives all these traders here a high probability retracement. So let's say a fair value gap, order block, and then drops off in the real move. What's actually happened there is something called a liquidity sweep or a stop run, right? And this right here is like the golden framework that you'll see in every single market on any time frame. It is the highest probability setup in trading by far. Now, can you see this anywhere in price action here? Now, this is a fairly difficult example. So if you can get this, in any like market, right, whatsoever. So can you see this anywhere in price action? Let's move this down, right? Can you see some sort of high that gets swept, price drops, gives you a retracement, and then drops again. Can you see that anywhere in price action? Right, if you can, congratulations. So study this high here. Right, can you see how we just go above this high here? Right, we just go above it, we instantly drop, and then we have our retracement and price drops again. Right, so can you see this high here? Price just goes above it, just wicks above it, goes down, gives you your retracement, and then drops. Right, very similar to this framework here. So let's clean these charts up, and I'll explain this in a bit more detail. So remember, step 1 was the bias with this blue line. Step 2 is our sweep. Right, now a sweep is simply a stop run, a liquidity sweep, whatever you want to call it. It's a fake move that takes out stop loss orders, allowing smart money traders to get into their position, right? Because these markets are highly manipulated and they only move for one thing, which is liquidity, where the money's at, right? And it's nothing personal against me or you. If you're on the right side of the market, you can make all the money in the world. You can make $1 million a month and it would be nothing to smart money because they are making billions in a day, right? And you know, if you're on the wrong side of the market, if you're stopped here, you're going to get punished, right? Simple as that. So can you see, let me make this really obvious. Can you see how this wick goes straight above it, aggressively goes above this high and then drops massively, right? Can you see this? Let me mark this out for you. You see how price goes right above it and then drops massively. Would you agree, and this is really important here, would you agree that this was a fake move? These green candles here going just above this high to take out stop loss orders and then quickly and aggressively reversing. Would you agree that this here was a fake move? Right, it was a fake move. This was not the real intention of the market to go up. Would you agree with that? Hopefully, right? Hopefully that's pretty obvious and making sense, right? This is a fake move that takes out stop loss orders and then price massively drops in the opposite direction. And if you're ever unsure about, you know, is this a sweep? Is it or is it not? Wait for a fair value gap to form in the opposite direction because that is the highest form of confirmation that you can get. But remember, the most important thing, the first step is always the bias, right? You know, if I didn't have the bias, I'd be like, oh, you know, we just swept this low here, you know, is this a sweep or is this a sweep? But because I know the bias, I know exactly what I'm looking for, right? If we were bullish, we'd be looking for some sort of low to be taken, but because we're bearish, we're looking for a high to be taken. So we have our sweep. This work here is our sweep. The confirmation is this massive fair value gap. Now that we have this, we go on to step 3, which everyone wants to skip straight to, which is our entry, right? Beautiful, bro. Look at this wick just filling the fair value gap. Right? Absolutely insane. But anyway, by the way, I saw this live in price action, right? This is live trading. And I thought, oh, you know what? Let me just make a video on this, right? Let me make a video on this. Those who don't know, I'm a swing trader now. Just because I've been day trading for years, right? And I want the free, what would you call it? The work-life balance, whatever. But sometimes I get tempted, right? Sometimes I get tempted. And I thought, I'm either going to trade this or I'm going to teach it or make a video on it. I thought, you know what? Let me make a video on it, right? I've got enough money now. Let me make a video on it. But anyway, here we go, right? Step 1, bias, which is the 4-hour low. Step 2, sweep. Step 3, entry. You can take any entry that you like. I like the fair value gap. So what you're going to do, let's just imagine you like the fair value gap. You're going to enter on the fair value gap. Your stop, really important, is going to be fixed at this high here that caused the liquidity sweep. There is no point whatsoever in waiting for a sweep if you're going to put your stop at the fair value gap or here or wherever. You have to put your stop at the liquidity sweep, high or low. There is no point whatsoever in waiting for a sweep. This whole framework will break, will fall apart, right? The bias gives you your direction, the sweep gives you your edge, and your entry makes you money. You probably want to write that down and put that on a t-shirt because that right there was a golden nugget, right? Super important. The sweep gives you your edge. It gives you your win rate, right? It gives you your win rate. This is how you get 60, 70% win rate in trading. It's by waiting for a sweep. If you don't wait for a sweep, you're going to be one of those guys who has a 30% win rate, you know, and like a free risk reward ratio and is barely profitable, right? After 100 trades, you know, they make $1,000, which, okay, yeah, it's fine, but they're going on, you know, massive losing streaks, you know, 10, 15 losing streaks, and most traders can't cope with that, not mentally, right? And you got into trading to make good money, be honest, right? You got into trading to make good money, not lose every, you know, like 9 trades out of 10, right? You got in this to make good money, real money, and you should do, right? So this is how you make life-changing money with trading. This is how you actually become profitable. Bias, number 1, sweep, then entry. So stop, always fix at the high. Now for take profit, and I chose an example deliberately, and you'll see why, right? I always target a 3-to-1. I always say this, just target a 3-to-1, get your money and get out of the markets, right? And this is why I always say this. This is your 3-to-1. beautiful entry, free risk reward ratio. You've got your money. You know, this is a 100k account, you're making 3k, you risk 1k, and per 100k account, you've got all your money, you're out of the market, right? You do not need to target this 4-hour low, right? You do not need to target. This just gives you your direction of the market, right? This just tells you that price is more likely, where is the path tool? More likely to go down here, right? We do not need to target. You do not need to, I cannot stress that enough. Some traders are going to get greedy, they're going to put their stop or their take profit all the way here, only to see price reverse. And I know it doesn't take you out here, but what's really happening, let's get back to the 3 to 1. What's really happening here, and this is super important, is as day traders and scalpers, what's actually going to happen here is price is probably going to go up, take out London high, which is the liquidity sweep, and then give New York traders that high probability entry on, let's say, a fair value gap stop here, and then they can ride price down. Right now, will it take out the 4-hour low? Who knows? Maybe it'll consolidate. Maybe it'll do in Asia. Who knows, right? No one knows, but that's probably what's going to happen. So I always say this: get your 3 to 1 and get out of the market, right? Get your money and run, because these markets are nasty and they can reverse quickly. And to be honest, all you need is a free risk reward ratio and even a 50% win rate, and you can become a millionaire with that very fast. Actually, it might not seem like that, but you know, you do 10. Let's say you've got 10 trades on a 100k account, risking 1% per trade, right? You lose 5, that's minus 5%. You win 5, which is plus 15%. That gives you 10% overall in a month, right? 10% on a 100k account, 10k a month. There's your 10k a month. Very realistic, right? Very realistic, especially if you're using this setup. You know, minimum 50%, but you can get a higher win rate. The first thing you want to do when you're trading any market, but especially the indices, is you want to wait for a liquidity sweep. You want to wait for a stop run, and then and only then do you want to enter your trade, because these markets are highly manipulated and they only move for one thing, which is liquidity or stop loss orders, right? It's the only reason these markets move. It moves for where the money's at. So big banks, smart money, whatever you want to call them, can get into and out of their positions. And can you see this low right here, right? This is the previous day's low. Now, it doesn't matter that it's the previous day's low, but it's a major significant low. And then can you see how price comes down? It shoots off, and then it comes towards this blue line here, right? This previous day's low. Lots of people are going to put their stop loss orders here, right? Remember, support and resistance, they're going to put their stop loss orders around this level, and they're going to hope that when price comes towards this blue line, they can just buy and price will shoot off, right? Now, if you've been trading for any length of time, you'll know support and resistance doesn't work, or at least it has a tiny win rate, like 30%. That's not good enough for me. I want a good win rate, right? So what we do instead, and you'll see this time and time again, right, is, can you see this low here? We know there's lots of stop loss orders at this low. Can you see this big wick here, right? Look at this. This wick right here. See how price wicks down, just one wick, right, on the 5-minute chart, goes below this low just enough to take out anyone who had their stop loss orders around this level here, because some people obviously don't put it right at this low here. They put it around the level, and then price instantly shoots off. I literally need to zoom out just to show you how much price shoots. I mean, look at this, right? Instantly shoots off. And this is something for your notes. Whenever there's going to be a big move in price action, there will always be a stop run first, right? Price will go down, smart money will take out liquidity, they'll get into their positions, and price will shoot off. And you see this time and time again. So how do we actually make money from this, right? How do we actually make money using liquidity, using all these strategies, right? The first thing you always do whenever you're trading any market, but you know, in this case we're talking about NASDAQ, is you wait for the sweep, which we've done here, right? So the moment this wick goes below this low, this is when two things can either happen, right? It could either be a liquidity sweep like we have here, and price shoots right off, or the second thing that can happen is this could be a larger reversal and price can go right down like that, right? Now, there are traders out there who, as soon as price comes down and takes out this low right here, they'll just start buying. They'll buy right away, and that's called turtle soup. You might hear traders talking about that. For me, that's very, very risky, right? It's not gambling, but it's very close to it, right? As close as you can get to it in trading. I like to see confirmation, right? I want to know, like, I don't know when price comes down here that this is a sweep. I want to see confirmation, and the easiest way to see confirmation is, first of all, to wait for price to shoot off. But the second one is just to wait for a fair value gap to form in the opposite direction, right? Don't just start buying here, or, you know, as soon as price moves up and hope that it's a sweep. Wait for confirmation, because confirmation in the form of a fair value gap is smart money screaming at you that it's a reversal. So the moment this fair value gap right here, this fair value gap right here forms, that is smart money screaming at not us, but at other traders, right? Hey, look, this is the time to get in, right? So all smart money traders trade very similar, almost the exact same. And their algorithms are coded actually in a way that once liquidity is taken out, you can enter on a fair value gap. But again, not talking about that in this video. All you need to know is that this can make you money and this can make you profitable, right? So here's our sweep. We know this is the liquidity sweep with the wick. And then fair value gap forms in the opposite direction. And this works on, obviously, NASDAQ futures, works on the CFDs. Now you might be wondering, hey, Atif, this is just before, or I think you just get tagged in at the open. The golden time to trade indices is anywhere between 8 a.m. Eastern all the way up to around 10 a.m. Eastern, right? That is the golden time because there's always lots of news events at 8:30, right? So I think right here we have a news event, but this right here, you know, if you get on the charts like 7, 8 a.m. Eastern, you want to be watching this liquidity here. But the moment you have the sweep, wait for a fair value gap to form, enter on that fair value gap. Now, let's actually enter on the fair value gap, right? So we're going to enter. So we're going to do the 5-minute chart here, but I'm also going to show you this on the 1-minute chart. So if you want a really tight stop loss and a sniper entry, I'll show you that too. But let's just do the 5-minute chart because this is more of a day trading strategy on the 5-minute chart. But on the 1-minute chart, you can get some insane risk to reward ratios. But the one thing you need to know when we're talking about liquidity sweeps is that the stop loss is always fixed at the sweep low, right? It's always fixed here. There's no point waiting for a sweep, and I keep saying this, but some of you are crazy, honestly. There's no point waiting for a sweep for price to come down and take out stop loss orders here if you're just going to put your stop at the fair value gap, right? There's no point doing that whatsoever. The only reason we wait for a sweep is so we have a safe place to put our stop loss. Very, very unlikely that price, because it's already taken out previous day's low, is going to come up and come back down and take out your stop loss and then go up. It can happen, especially on the lower time frames, which is why, as a general rule of thumb, the higher the time frame, the more reliable the price action is. But this is 1 in 10 this might happen, right? Very, very low probability. In fact, the guy was messaging me about fake liquidity sweeps. I think this is what he's talking about, right? This does happen occasionally, right? Where price will come and take out a low, but very rare, maybe 1 in 10, if that, 1 in 20 maybe. Like I almost never get that, but anyway, here we go. So you're going to enter on the fair value gap. Like I said, I'll show you on the 1-minute chart how to get like a tighter entry, but let's just imagine you want to trade on the 5-minute chart. Stop loss fix here. Take profit. For me, I aim for a 3-to-1, but minimum, just target the opposing liquidity. So what is this? This is basically London's high, but it doesn't really matter, right? It's a major high. What do we have? Price comes down, shoots off. This is the major high. Takes out liquidity, and then goes and takes out opposite side, opposite opposing liquidity. I mean, you probably want to screenshot this right here, because you'll see this time and time again in the market. Let me just remove this thing, right? Price will come, let's say, or leave equal lows. Sorry, or leave a low. Price will shoot off. It'll come down, just wick below an old low, taking out stop loss orders, give you a fair value gap for all the traders to enter on, and then shoot right off. So you probably want to get a screenshot as well. Put that on like your wall somewhere so you can look at it, because this made me rich, and it'll make you rich too. It's made countless traders rich as well. But anyway, take profit minimum. Like if I'm trading on the 5-minute chart and you want to be a day trader, I just target the opposing liquidity for a 2.3 risk to reward ratio, which is all right. But for me, I like a 3-to-1. Right, I've always, after 5 years of trading, the only thing I do, you get the point, don't you? We get it? There we go. I just aim for a fixed, free risk to reward ratio. It doesn't matter if I'm trading indices, forex, gold, crypto, stocks, always a free risk to reward ratio. It just makes my life easier. But yeah, it doesn't really matter. You get take profit, right? Take profit is the easy part. Just target the opposing liquidity or a 3-to-1. If you're trading the 5-minute chart, don't go above a free risk to reward ratio. If you want like a really high risk to reward ratio, I'll show you now how to do that on the 1-minute chart. So first thing you want to do is just clean this off. Now remember, before I got on the 1-minute chart, we have this low, price comes down and sweeps out this low, right? This is the framework we're working with. So when we get down onto the 1-minute chart, we're going to look for the exact same setup, but on the 1-minute chart. Okay, so here we are on the 1-minute chart, and you can see basically the exact same thing on the 5-minute chart. Price comes down, it goes up, it leaves this high, just wicks below this low, gives you a fair value gap here, which I'll show you, and then shoots right off, right? So how do we get our high probability sniper entry? And like I said, literally any time around 8 a.m. Eastern onwards is a golden time for indices. 8 a.m. to around 10, 11 a.m. Eastern is probably the best time to trade indices. Unless you want to trade the PM session, which is not the best, to be honest, but you can still make a lot of money from it. Anyway, this is the liquidity. This is the sweep. So when price goes below it, this is our sweep. And do you know how I said I always like to wait for a fair value gap to form in the opposite direction? Then and only then do I know it's actually a sweep. We do the exact same thing here, right? Doesn't matter what time frame you trade. You can do this on the 15-minute. You can even do this on the 4-hour chart, right? This is what I do as a swing trader, but the exact same setup works on every time frame, right? Because price is fractal. But anyway, as soon as this fair value gap forms, right? So as soon as this little weird doji candle forms here, and we have the fair value gap, that right there, we know, okay, this is a liquidity sweep, right? Very high probability that price is going to shoot right off. So you're going to enter on the fair value gap. And do you remember how I said stops always fixed at the liquidity sweep low? Let me just zoom out, right? So this is the liquidity. Here's the sweep. Stop always fixed at the low, right? But we're on the 1-minute chart, so you can have a decent stop loss, right? Like a wide stop loss, because we can get a really good take profit. So here's the fun part about the the 1-minute chart. So I mean, if you're on the 1-minute chart, there's no point aiming for a 3-to-1 if you can do the exact same thing on the 5-minute chart, in my opinion. That's just my opinion. If you like the 1-minute chart, you like a 3-to-1, you're making money, but you do you, right? You back test this, you see what works for you. But for me, like if I'm going to get the 1-minute chart, I want to be compensated for it. So you've got opposing liquidity all the way up here, which is a realistic target, right? London sessions high? Very realistic. So this is how people get some insane risk to reward ratios on futures. And you see this set up almost every day, at least in one of the major ones, right? NASDAQ, S&P, or Dow, right? So this can be your take profit, 6.5 risk to reward ratio, or you can start targeting, I mean, what would this be? Previous day's high. I would not go above previous day's high, especially on the 1-minute chart. I mean, look at this. You do get it tagged as well, like a 1-to-9. Like, come on, bro. Yeah, exactly, right? So you don't want to do anything crazy like a 1-to-10, because you could have something like this happen, or price just consolidates. But you get the point, right? Take profit, always easy part. Hard part is the logic, but I think this is pretty simple. Hopefully this video is pretty simple. Wait for a sweep, wait for a fair value gap, enter the trade, and you can become profitable. Okay, so after 5 years of trading, I've literally simplified trading into the simplest formula I can make, which is bias, sweep, entry. If there ever was a holy grail to trading, it would be that, right? And the first thing you need when you get onto any market is you need a bias. There's lots of influencers out there saying you don't need a bias, trade what you see. That is a load of BS. We need to have a bias or a likely direction for the market. And once you've got the bias right, you're 90% of the way there. But the easiest way to determine bias is to get onto the 4-hour chart for whatever market you trade and simply, right, imagine you're at the charts at this point here. Simply ask yourself, which high, so this high here, or which low are we more likely to go for? So is price more likely to come up and take out this high, or is it more likely to come all the way down and take out this low? Right? And that might sound like a stupid way of doing it, but I'm telling you, if you do that, 90% of the time, you will get the correct daily bias, right? You don't need to do some complicated weekly analysis, daily chart, multi-market analysis. You can do that if you're already profitable. Let's say you have a 50% win rate and you want to increase your win rate to 60, 70%. There's videos on the channel for that. However, if you just want to make money, this is the easiest and simplest way of doing it. You just ask yourself, which high or low is price most likely to go for at this point? And hopefully it's pretty obvious. Price is going to go for this high here, right? Why is it going to go for this high here? And if it was bearish, you see this big order block, smart as that, this big order block. If price was actually bearish, what it would do is it would have tapped the order block and quickly reverse, right? Has it done that? No, it's smashed right through it. There's no respect of any bearish order block or fair value gap. And we have this nice liquidity pool right here, right? And liquidity is the only reason these markets move. For liquidity, stop loss orders, money, whatever you want to call it, it's the exact same thing. Big institutions, smart money, they need to get into and out of their positions where there's billions of dollars, and they can only do that at major highs and major lows on the higher time frames. This is why we do the analysis on the 4-hour chart, not the 4-minute chart. But anyway, we now know our bias, our daily bias, our likely direction for the market is that price is going to come up, right, and take out this high, right? Now, as day traders, as scalpers, even as swing traders, we can make money doing that, right? But bias is step one. Number two is the sweep. So now we need to get onto the lower time frames. Now, I'm just going to assume we're going to trade the 5-minute chart, but you can use any time frame that is below the 4-hour chart. In fact, you can even trade the 4-hour chart itself if you want to be a swing trader. But let's imagine you trade the 5-minute chart and we've got this nice liquidity pool, this 4-hour liquidity that we've just marked out, right? So we know, we talked about this, we know that price is going to go for this high, right? But obviously, the markets don't move in straight lines, right? You know this. Does the market move like this? No, right? No, it doesn't do this at all. And in fact, the old what do you call it, mantra of buy low on some fair value gap order block, sell high also does not work, right? Has this worked for you? Just buying the dip, sell the rallies? Probably not, right? Probably not, because the markets, believe it or not, the financial markets with billions or trillions of dollars moving through it every day can be kind of complicated. So how these markets actually move is, let's imagine we're bullish, which we are, and we're going to target this liquidity pool. How smart money actually move the markets is, let's imagine we've got some low here. Doesn't have to be a major low, but we've got some low here. Is that price will go just below this low where there's stop loss orders, where there's liquidity. This can be, you know, London's low, Asia's low, or previous day's low. Doesn't matter, any sort of major low in price action. And then price will shoot off, and then it will retrace, giving smart money traders their entries on a fair value gap order block, and then price will shoot straight off to take profit. This is how the markets move. And again, you probably want to take a screenshot of this little image right here, because this you will see time and time again. In fact, after every major move, or before every major move, there will be a little stop run here that takes out stop loss orders. Price will shoot off, retracement, and a massive explosion in price action. It's just how the markets move. This stop run here allows smart money traders to get in. Some of them are buying stop loss orders. And then the second retracement here is the high probability entry, which all the traders, all their algorithms are entering on. But anyway, how do we use this to make money? So this example here that I've given you, can I make this a bit smaller? Let's move this over here, right? This example here I've given you on silver on the 5-minute chart is fairly difficult. In fact, it's probably one of the more difficult examples. So if you can spot this in price action, congratulations. And if you can understand this example, you can understand any example, right? Because I don't want to just give you some, cherry pick hindsight, right? Where we've got some low and then price shoots off, gives you, a sniper entry, 10 to 1, goes straight to take profit, because that's not how trading actually is, right? Not every day is price action going to be amazing for you, but you can still make money doing it, right? So let's just keep this graphic here, right? Just for illustration purposes, right? Just remember, this is the framework we're looking for. Now, can you see this anywhere in price action? Now, remember, I did say this is a fairly difficult example, but can you see this anywhere where we've got some sort of low, price goes off, gives us our retracement, and then hopefully shoots off to take profit, right? Now, this is a fairly difficult example for two reasons. So the first thing we want to do is, and remember, we're on step 2 now. So we have our bias. We know price is going to go for this high, this 4-hour liquidity, which we talked about at the beginning, which is the most important thing, right? There's a reason why we do bias first, then sweep, then entry. We need to have a direction. If we didn't have a direction, we would think, oh, is this a sweep? Like, where's a sweep? So we need to have the direction. But number 2 is simply a sweep, which is all we need. Now, this low here is Asia's low. Now, for those who are asking, this is New York time, Eastern time. I live in the UK. I'm not on London time. Where's London time? I'm not on London time. I'm on New York time. It doesn't matter where you live in the world. Even if you live on, the West Coast of America, make sure you're using New York time. It's just how the markets move. But yeah, this low here is Asia's low, right? This is Asia's low right here. So, can you see how price goes just below it, just enough to take out anyone who had their stop loss orders around this level, and then starts to shoot off, gives you a retracement, and then shoots off, hopefully shoots off again, right? That is what we refer to as a liquidity sweep, a stop run, purge, all these weird names that you hear, a grab too. And I know different people refer to it as different things, but whatever. I just call it a sweep or a liquidity sweep, which is what I see it. It's a stop run. Right? That's all it is. It's a fake move, takes out stop loss orders to give smart money traders their entry. Now you might be thinking, oh, Atif, this is a 5-minute on silver. Is there really enough stop loss orders here? And there is some money here, right? We don't know how much, but not just traders, algorithms in particular. So smart money on the lower time frames, their algorithms are trading this. There's more liquidity here than you think, right? Could be a billion, right, on silver, a major market, so enough for smart money to get in. Now, what makes this difficult is if you're a day trader or scalper, is you have to be looking at key sessions. Now, you'll see the key times on screen now of the sessions. You have 8 p.m. Eastern to 12 a.m. Eastern, that's Asia. You've got 2 a.m. till 5 a.m. Eastern, which is London, and you've got 7 a.m. till 10 a.m. Eastern, for New York, right? And this is for forex, and obviously the whole of indices open is essentially the golden time for futures, but really 10 a.m. to 11 a.m. Eastern is probably the best time to trade indices or futures. But right here. So remember, this is what makes this difficult, right? And the reason why price doesn't just take out this low and shoot off like we normally see is because this is what I refer to as dead time, right? It's end of Asia. Asia really ends around midnight here, and London doesn't really start until 2 a.m. Eastern. So we have a bit of chop, and you can see this almost beautifully in price action. Price takes out liquidity, it chops for a bit, and then where's the 2 a.m. candle, right? This one here, isn't it? This little red one. Where's it? This little doji here, right? Look at this. This 2 a.m. candle right here. Then price starts to shoot off. Price will consolidate during the, what do you call it, the gap between two sessions, and then when the key session hits, it will start to shoot off. Then price shoots off, then it gives you a retracement, and then hopefully shoots off to take profit, right? So we have our sweep, and we know, if you're a day trader or scalper, we're going to be trading during key sessions. Can you trade outside of the session? Yes, but you're going to have a lower win rate. But, if you're day trading or scalping, you should be trading within a session. If you don't want to look at sessions, go be a swing trader. But, if you're going to be a day trader or swing trader, you need to be looking at a key session, right? So we've got number one, which is the bias. Right here, right? This liquidity is the bias, our direction. Number two, the sweep. Last but not least, we need a simple entry, right? This is why I say the entry pattern is the least important thing, right? If you've got this direction, which we have all the way up here, and the sweep, any entry will make money, right? So let me give you like 4 or 5 entries. Fibonacci, this is what I use, optimal trade entry, 0.705 level. Enter on that, target 3 to 1. That could be your entry, right? You could have this order block here. But what I always say, and the easiest way to determine a liquidity sweep is just to wait for a fair value gap to form in the opposite direction. Now we do have a fair value gap all the way up here, and it is a fairly high stop loss, right? Because whenever you look for a liquidity sweep, your stop always has to be at the low that causes the sweep, right? The reason we wait for a sweep is so we can put our stop in a very safe area. So only reason we care about a sweep, right? We're not going to wait for a sweep and put our stop here, right? Completely pointless if you're going to do that. There's no reason waiting for a sweep. So the reason we wait for a sweep is to put our stop here. But obviously, if we enter in this fair value gap, we've got a massive stop loss. So can we get a better entry? Yes, we can, right? Now, this is where I said this example is fairly complicated. And if you can understand this, and if you've understood it so far, congratulations. You can become a profitable trader, right? I mean, this is a very difficult piece of price action. So in real, trading, it'll be a lot more simple than this, 9 times out of 10. So I want to draw your attention to this thing here. Can you see this little bit of a mess in price action? So when you've got 2 gaps, right, can you see this, how we don't have any bodies, but we've got these wicks covering each other here and here, right? This is something that's referred to as a volume imbalance. Now I know there's 2 of them here, just for simplicity, and I guess just to make it for illustrative purposes, I'm just going to mark out this entire thing, right? This is what's referred to as a volume imbalance. Someone was asking me, hey, what is a volume imbalance? It's essentially this. Now, I know the definition is slightly different, but for simplicity, it's this weird gap in price action, right? This right here acts as like a super fair value gap. Now, what I mean by that is essentially everyone knows that we have, a fair value gap, price draws towards it. But can you see how price disrespects this fair value gap here? Like it just breaks right through it and it goes towards this volume imbalance before it starts to shoot off. The reason it does that is because this right here is a magnet on price action. It will always pull price towards it. So you can enter on this volume imbalance. Now, again, like I said, entry pattern really does not matter. If you go into lower time frames, and what was it, the 2 minute, 1 minute, 3 minute, 4 minute, you probably will find a fair value gap somewhere in here that you can enter on. But just for simplicity, let's imagine you enter on here. You're going to always put your stop at the sweep low, and then for your take profit, for me, I target bare minimum 3 to 1. You may as well target this high right here. I mean, it's just easy liquidity. If you really want to, you can start targeting liquidity here, here, here. Now, people are going to ask me, hey, Atif, do we need to target this high? No, just trade in the direction. Only thing you need to do is trade in the direction of it, because a lot of the time what will happen is price will shoot up. It'll take out, let's say, these highs here, and it will consolidate and start to reverse for next day's price action, where it can, I don't know, let's say sweep this, give you an entry in London, and then take it out in London session the next day, right? So you don't want to just Hail Mary, unless of course you want to be a swing trader, you want to hold on. It is what it is. But again, take profit is the fun part, the easy part. If you've got the bias, you've got the sweep, you've got your entry, we're really just talking about how much money to make, right? Which is always, a good problem to have. But yeah, let's just see what price does. Let it enter, let it do its thing. And yeah, look, I mean, in this case, again, this is why I say, and you'll see this a lot in price action, whenever price takes out key liquidity, like it does here, on the, major liquidity on the 4-hour chart, is it will dump massively, right? It will quickly reverse. So I always say this, get your money and run. Get your money and run. These markets are very, very risky. Get your money and run, right? For me, I always do a free risk to reward. And, you do whatever you like, right? Target opposing liquidity. You do whatever you like. Okay, so for this strategy, we really only need two things, right? We need a 4-hour fair value gap, and then we just need a lower time frame fair value gap. Now, do you remember in the intro how I was saying we don't need daily buyers for this strategy? The reason we don't need daily buyers is because we're going to use the 4-hour chart, which acts as our higher time frame, because you need to be using a higher time frame. If you don't, then you're essentially trading blind. But for this strategy, or this trading strategy, all we're going to do is we're going to mark out the most recent fair value gap in price action, right? Which is this big bearish one right here. Now, you might be wondering, if you're eagle-eyed, you might be like, oh, Atif, what about this fair value gap here? Well, all we really care about is we just want to see price enter this fair value gap, right? So I do not care. I'm not waiting for this candlestick to close. All we care about, because you got to think, right? This is only a fair value gap once this candlestick officially closes. All I want to see is, so this was the most recent fair value gap. All I want to see is price hit this fair value gap. And then I want to see how price reacts on the lower time frames, because what we really want to see is, imagine this is now the 5-minute chart, not the 4-hour chart. We want to see price hit this 4-hour fair value gap, shoot off in the lower time frames, give us any sort of retracement, let's say, on a new fair value gap, and ride price down. So I'll show you what that looks like on the lower time frames. But just remember, we do not, this is not a fair value gap until this candlestick officially closes, right? This is the fair value gap. So once this candlestick officially closes, then you've got this fair value gap. But all we do care about is we just want to wait for price to hit the 4-hour fair value gap. Now that it's done that, we're going to get onto our lower time frames and start looking for our entries. Okay, so now that we've marked out the 4-hour fair value gap, all we need to do, and you remember how I was saying, all we need to do now is wait for price to hit this 4-hour fair value gap, shoot off, and then give us a retracement, and then ride price down, right? Now, there's a few ways in which you can do this, and you can use this on multiple time frames on the lower time frames. In fact, I'm probably going to give you at least 2 or 3 entries. But what you want to do for this trading strategy is we want to see confirmation that this is actually a real bearish fair value gap that's going to hold, because there are so many fair value gaps in trading and order blocks too that just fail, right? And you probably had this, like, be honest, you've had this where there's a fair value gap, you've entered on it, and price just smashes right through it, almost like the fair value gap doesn't even exist. The reason why is because we need to wait for confirmation. And if you remember, this 4-hour fair value gap was a big bearish fair value gap. But we can't just randomly start selling as soon as price hits it, because we don't know what price wants to do. It could shoot right through it, and it might chop for ages. So we need to see confirmation. And the easiest way for this trading strategy to see our confirmation is to wait for a fair value gap to form in the direction of the 4-hour chart. Now, what I mean by that is once price hits this fair value gap. Now, remember, this is a bearish fair value gap. This is why I say, or this is why I was saying in the beginning, we need to use the higher time frame, right? This is a bearish fair value gap. So what we're waiting for is the first bearish fair value gap that forms on the lower time frame, right? Which in this case is the 15-minute chart, because that will essentially act as our confirmation, essentially smart money screaming at, not us, and I always say this, not at us, at other traders who are smart money too. This is a time to get into the position, and this is what algorithms are going to look for, right? Because if you've done any sort of programming, you'll know, you can't just tell an algorithm to just buy or sell randomly, right? But it's very easy, you can imagine, to code this. If price hits 4-hour fair value gap and 15-minute fair value gap forms in the same direction, enter the trade. Obviously, I'm not a programmer, right? I did maths at uni, not computer science, but you get the point. If you've done programming, you can imagine, right? This is how their bots are coded. Anyway, that's for another topic. So you can see here, right? This big fair value gap here, not big, sorry, this quite small fair value gap, but nevertheless, still a fair value gap that forms in price action, right? This little fair value gap here forms. This is your first entry. Now, don't worry, I'm going to give you multiple different entries for this trading strategy, because this right here is probably the hardest one. But if you spot it, and you got to think, this is the 15-minute chart, right? So you do have time, right? It's not the 1-minute chart where it moves fast. This is the 15-minute chart, so you could easily put your limit order in place, right? But this fair value gap here is a valid fair value gap. Someone was asking me, hey, Atif, I have a small fair value gap. Is that all right? Yes, right? If there's any gap remaining in the fair value gap, that is a valid fair value gap. But this right here is the first confirmation that this is really, this big 4-hour fair value gap over here is actually going to hold, right? That price is actually bearish, right? Price shoots up. Just zoom out a bit. I mean, look at this. This is why I love the 15-minute chart. All right, look at this. We've got the big 4-hour fair value gap here. Price shoots off. Where did it go? It's slow. Look at all these. Look at how strong these big bearish candles are here. Look at how weak price action is here. So weak. Lots of wicks. Taps it. Instantly drops. Here's your high probability retracement and ride price down, right? So let's just remove this. This is your first entry, right? But what I normally like to see is I like to see price shoot off, give me a retracement, and I like to enter on a fair value gap here and then ride price down. But if you look very carefully in price action here, and this is a more difficult example, there's really no bearish fair value gap. Now I know there's one down here, but this is quite a big stop loss. So whenever you have this in price action, and you can see this in the PDF, in the pinned comment down below when you've got it up, I give you examples, I'm pretty sure on the 15-minute chart, but you can use any time frame that's less than the 4-hour chart. You do not change the 4-hour chart. You always use the 4-hour fair value gap, and then you can use whatever lower time frame you like, right? 1 hour and below. Obviously, if you're using the 4-hour and 1 hour together, you may as well be a swing trader at that point. You're not really a day trader. You're not going to get many setups. 15-minute and below, absolutely fine. But whenever you have something like this where price shoots off, it gives you a retracement and there's no fair value gap that you can see. Because remember, this wick here fills the fair value gap. And what you do is you just move on to the lower time frames, right? So you'll move on to the 5-minute, like this. And again, if you look really carefully, if you wanted to enter on this easy high probability retracement during New York session, there's really not any fair value gap for you to enter on. However, if you wanted to trade the 5-minute fair value gap, and you remember for this strategy, what do I say? I said the first fair value gap that forms inside this 4-hour fair value gap, the first bearish fair value gap that forms within this 4-hour bearish fair value gap, that's your entry. So if you wanted to trade the 5-minute as more of a scalper and get a better risk to reward, that little fair value gap there is your entry. Stop. I mean, again, like I was saying, stop wherever you think is reasonable. I think here's fine. You can do it here too. And then for your take profit, minimum 3 risk to reward ratio for me. You can target this easy liquidity. And what is this? A London session trade, easy London risk to reward, take profit, wait for price to come up, and then short it again during New York. Beautiful price action. And for those who don't know, you probably want to take your notes out here. New York is almost always a continuation of London. So London, like it has been here, is bearish. Expect New York to continue downwards, right? So little golden nugget here. But finally, and I want to give you guys as many examples as possible because I know not everyone wants to trade the 15-minute or even the 5-minute chart. And I want to see a fair value gap form. I'll show you what I want to see, right? I want to see something like this. I want to see a valid fair value gap that forms that isn't filled already that we can enter on in this retracement, right? So I want to see price. I want to see a fresh fair value gap that we can enter on and then ride price down. Now, I'm not going to waste your time and show you every single time frame. I'm just going to get straight to the point. What you would do is you go onto the 4-minute, 3-minute, 2-minute and 1-minute chart until you find one. And you can even do the seconds chart, but I don't do that. Maybe if you're trading futures, you want to do that. But for me, or not for me, but for this example, if you go into the 3-minute chart, we look very carefully, what you'll see, if you look really carefully, is you'll see a fair value gap here, right? This right here is a big bearish fair value gap. Now, can you see how price fills part of the fair value gap and then drops off, right? But it leaves this bit here remaining, right? This bit of the fair value gap's remaining. I hope that makes sense. This is still a valid fair value gap. This part here has been filled by this green candle, but this bit here is still remaining. So, and can you see how, look how beautiful this is. This is how you get those sniper entries, right? I know almost everyone on Instagram, they're all lying and stuff, but there are traders, right? There are actually other humans out there who are actually getting crazy risk reward ratios consistently. This is how they do it, right? Now, the win rate isn't, insane. It's pretty low, for about 20-30%. However, if you're getting like an 8 risk reward ratio, you can make a lot of money with that. Very hard mentally to deal with, but you're getting money to justify it, aren't you? So anyway, this right here is your fair value gap. And you know how I was saying, I think these entries are the easiest, right? Where you see price hit the 4-hour fair value gap, shoots off, gives you a retracement, ride off. I think that is the easiest entry in all of trading, right? You don't have to react very quickly to a fair value gap. You've got so much time to plan your trades. What you would do, and look at this, the wick just taps it, instantly starts dropping, right? This is what you would do. Stop anywhere you think is reasonable. I think this high is more than enough. And then take profit. target at least a 3-to-1. I mean, we can make a lot of money here. At least a 3-to-1, or just this easy liquidity pool here. Okay, so the first thing we're going to do is we're going to get onto the 4-hour chart for this trading strategy, and we're going to mark the most recent fair value gap in price action. Now, it's really important to understand this trading strategy, even though it's on New Zealand dollar against the US dollar, will work on any market. If there are candlesticks on the trading chart, this will work, right? If you can see a fair value gap, this will work. But what we're going to do is we're going to get onto the 4-hour chart, and we're going to mark the most recent fair value gap in price action. Now, if you don't know what a fair value gap is, go look at this picture on screen now, which explains what it is. It's a very simple entry pattern. All it is the gap between, when we're bearish, this candle wicks high and this candle wicks low, right? That's all it is. It's a simple pattern. The pattern itself does not make money, it's the logic. But for this trading strategy, what we're going to do is we're going to mark out the most recent fair value gap in price action. Now, if you spotted this, well done. This is the most recent fair value gap in price action. However, this wick completely fills this gap here. So let me mark this out for you. This fair value gap right here, can you see how this wick fills and breaks through the fair value gap, right? That fair value gap right here is no longer valid. A big red cross through this fair value gap. It is no longer valid because this wick broke right through it. So remove this. The next fair value gap is this big juicy fair value gap, right? We always want to see this because this is really important when you've got a big fair value gap, right? It's a huge sign from smart money, but all we need to do for this trading strategy is mark out this fair value gap like this, right? Remember, fair value gap's the gap between this candle wicks high, this candle wicks low. Wait for price to hit it, and then as soon as price hits it, so as soon as you start to see price go into it, you don't even need to wait for the candlestick to close, but as soon as price hits this fair value gap, you're going to get onto the 15-minute chart, and we're going to start to look for our entries, right? So that's the only reason we use the 4-hour chart, right? Just to mark out a 4-hour fair value gap. Now, you might be wondering, why are we using a 4-hour fair value gap? This acts, and you can see the 4-hour fair value gap like right here in price action. That acts as our higher time frame, right? This tells us our daily bias, and it tells us smart money's intention. So I feel like when you have the logic behind a trade, it gives you a lot more confidence. You know, when you're on like losing streaks and stuff, when you understand the logic behind why you're actually taking the trade rather than just like a random indicator, and you're a lot more confident when you go through losing streaks or just in general, right? Like putting money on the line. So this 4-hour fair value gap is a massive clue to smart money traders that price is moving in the opposite direction. However, we can't just randomly do this, right? We can't just randomly start to sell as soon as price hits this fair value gap. We need to wait for confirmation. And what confirmation really looks like, let me make this really clear. So this is the 4-hour fair value gap, which we just talked about. What confirmation really looks like is price hits it, it drops, like it starts to reverse in the opposite direction. It gives us a retracement, a high probability retracement, which smart money traders get on, and then price drops like a brick, right? That is what confirmation looks like, right? We want to see price shoot off on the lower time frame, on the 15-minute chart, as soon as it hits this big, juicy 4-hour fair value gap, right? I know I keep saying juicy, but bear with me. So you can use this, you can use any time frame really, as long as it's below the 4-hour chart, right? But for this example, and in the PDF down below in the comments, I've just used the 15-minute chart because it's simple, and the reality is the higher the time frame, the higher the win rate, but the less setups you'll get. So, you know, you can do this on the 5-minute or 1-minute chart. The exact same principle applies. But what you're going to do is, and obviously if you're day trading, you need to do this at a key time of day, right? So we're not going to trade at any random time. We're going to do this at a key time of day. So can you see this massive wick here? This is a news event, so almost just ignore this wick, right? And you can always tell it's a news event when it's got this massive wick and then quickly goes off in the opposite direction, right? Completely ignore this wick, almost just act like it doesn't exist because it's just like a news event. But can you see, really important here, right? How price comes up, it chops for a bit, ignore this news event, it chops for it, chops for a bit, moves up a bit, retracement, and drops, right? Really important here. So for our entries, the thing that we care about is, first of all, we need to see it at a key time of day, right? So the first thing you're going to do is mark out the 4-hour fair value gap. Then you're going to wait for price to hit the 4-hour fair value gap. And then you're going to wait to see, is this at a key time of day or not, right? Now, for those who don't know, this is in New York Eastern time, right? Doesn't matter where you are in the world, just use New York Eastern time because it's just easy. And it's almost a standard that all traders use, right? Whether you live in the UK like I do, or in Dubai, or, you know, Japan, wherever you live, just put New York Eastern time, right? Makes it simple for all traders. But for Forex and for any market in general, 2 a.m. Eastern, right? 2 a.m. Eastern, all the way really to around 11 a.m. Eastern is like the golden move, right? That is when you have London, so you've got all of Europe awake and you've got the Americans awake, right? That big overlap session. So 2 a.m., mark this down for your notes, 2 a.m., which is right here, all the way until 11 a.m. That's like the golden zone for trading, right? Because you've got Europe, you've got, the Middle East, like Dubai and stuff, and you've got the Americans all essentially, awake at that time, right? But anyway, besides the point, what we care about now, and do you remember how I said earlier, we want to see price hit it, drop, give us retracement, and then ride price down, right? Do you remember how I was saying that before? Well, what we need to see, and it's always subjective. You know when you hear these guys online saying, you want to wait for confirmation, we want to wait for reversal, we want to see price quickly move off in the opposite direction. What does that mean, right? Now, the easiest way of saying this after years of trading is just to wait for a fair value gap to form in the opposite direction, right? So remember, this big fair value gap, and you can see it right on the 15-minute chart. You can use your imagination. You can imagine this being one big 4-hour fair value gap like we just talked about. What we really want to do is we want to see price hit this, right? Hit this bearish 4-hour fair value gap, form another bearish fair value gap on the 15-minute chart or whatever time frame you're using. I'm using the 15-minute chart. You can do this on the 1-minute chart, and then we want to enter on this new bearish fair value gap and ride price down. That bearish fair value gap that forms, the first bearish fair value gap that forms in this, doesn't have to be in this 4-hour fair value gap, but once price hits this 4-hour fair value gap, the first bearish fair value gap that forms, that is smart money essentially screaming at each other, right? Telling each other, this is the time. This is the time to get into the trade, because you cannot get more confirmation than this, right? So remember, 2 a.m., we're going to start looking for our entries. We're not doing it at, end of Asia. It's not London. It's dead time where price chops, right? Asia's all the way down here. We're going to wait for the first fair value gap that forms after 2 a.m. or at 2 a.m., right? So the first fair value gap that forms, the first bearish fair value gap that forms is this one. Really important to understand this, right? There is a fair value gap here that is invalid, right? The reason why is this is a bearish fair value gap, right? This is a bearish fair value gap. You do not look for bullish fair value gaps. You completely reject this, right? The 4-hour fair value gap tells us our bias and direction. We're looking for confirmation. So completely ignore the bullish fair value gap. This is why so many traders go wrong, because they just look for the entry. The entry is the least important thing. You need to have the direction or the bias right? You need to have that right. So ignore this bullish fair value gap. This is what we care about here, right? And I'll show you 2 different entries, which is it's actually really nice here. This is actually a beautiful bit price action. But this fair value gap right here in the heart of London session forms bearish fair value gap, right? This is what you want to mark out, and this is what's going to be your entry, like this, right? Mark out this bearish fair value gap that forms on the 15-minute chart. There's your confirmation. There's your confirmation that price is actually going to reverse, right? This is your confirmation that price is going to hit this 4-hour fair value gap and start to drop. That's your confirmation. That's what we're looking for. We're not blindly just selling as soon as price hits this fair value gap, right? Because that's just gambling, right? We want to see confirmation, and waiting for a fair value gap to form in the same direction as this big 4-hour fair value gap is the easiest way to do it. So for your first entry, let's say you're a London trader, you're going to enter on this fair value gap. Now for your stop, realistically, your stop can be anywhere. Obviously don't be stupid and have it like really tight, right? But for me, just put your stop at this high, right? Just put it at this high. You don't have to, right? If you're really, if you really want a tight stop loss. But remember, tighter the stop loss, the higher the chance that you're going to get hit, right? Your stop's going to get hit. So for me, we're on the 15-minute chart, we're day trading. Just put it at the high, right? Put it at the high, 6.3 pip stop. And then for your take profit, from minimum, if you've been watching my channel for a while, you'll know I always target a 3-to-1, easy free risk reward ratio, because you can get that every day, right? Using this strategy, you will get a sell every single day. Will it be in New Zealand dollar every day? No, but it will be in multiple. You'll find a sell in one market, right? In every single session, if you look hard enough, which is why I'm a big believer in not trading one pair. In fact, I think that's probably one of the worst things you can do is trade one pair. You want as many pairs as possible, and you want to cherry pick the absolute best pairs to trade on the day. But anyway, that's a topic for another video. So 3-to-1 minimum, right? Stop wherever seems logical. Don't be stupid. Don't put it really tight. And if you want to, and this is why I love the 15-minute chart, can you see this low and this low here, right? Nice, lovely bit of liquidity here. Now, if you don't know what liquidity is, absolutely fine. You do not need it. Although liquidity will increase your win rate massively. Liquidity is simply stop loss orders, right? You remember support and resistance? You remember how people say that price will bounce off like this? You remember that? You probably remember hearing about this. What actually happens, even if price is bullish, this is what will happen. Price will never bounce off these lines, this line, unless it's going to generate more liquidity, unless it's going to get more people to start putting their stop loss orders here. What will actually happen, if price is going to reverse, is it will go down, it will take out liquidity here and here, it will take out all those stop loss orders. Smart money, those with billions, will start buying, and then they'll ride price off in the other direction. It will never, right, do this, right? The only time it ever does this and respects this random blue line is just to get more traders to put their stop loss orders there. Or you might hear that before, you might hear people saying generating liquidity. Really the exact same thing, right? Really the exact same thing. So you can target this liquidity for an easy, I mean, this is the 15-minute chart, guys. It's the 15-minute chart. You get on the 5-minute or 1-minute chart, you can get an even tighter stop loss with an even bigger risk to reward ratio. But this is an easy setup on the 15-minute chart. And I think this is probably the easiest setup in all of trading. Obviously, you know, if you want the highest win rate, bias, sweep, entry, you know, liquidity sweeps, that's what you want to be looking for. But if you just want to make money ASAP, I mean, I cannot make a strategy as simple as this, right? I deliberately removed liquidity from it. I know, you know, I love liquidity, right? You know, I have to mention it in every video, but you don't need liquidity, right? Lots of people struggle with liquidity. So if you do, this could be the trading strategy that makes you profitable, right? So you remember how I said I was going to show you a second entry, right? So you know how I said I was going to show you a second entry? Let's imagine that, you know, you live in the US or whatever, right? You can't trade London session. You've missed this setup and you're around here in price action, right? Around New York time is when you trade, or you just want to trade the New York session. What you can do is you can enter on the next fair value gap that forms in the price range. Now, really important here. Really important. Pay attention, right? When you are bearish, you want to pick the highest fair value gap. When you are bullish, you want to pick the lowest fair value gap, right? So I'm not going to talk about the bullish example, right? Actually, yeah, I am. There's two fair value gaps here. You want to pick the lowest when bullish. You do not want to pick this one here. You do not want to pick this one here. And when you're bearish, you do not want to pick the lowest. You want to pick the highest fair value gap, right? Almost essentially saying you want to sell high, buy low, right? Buy low here, sell high, right? You don't want to be buying all the way up here. You don't want to be selling all the way down here, right? So if you've ever got two fair value gaps and you're bearish, pick the highest one. Do not do that. That right there is, that right there will make you so much money. It's insane, right? It's insane. Who doesn't love money? I mean, look at this, right? How beautiful this is with the bodies almost respecting it. Let's just make this a bit more big. It doesn't look as sexy now, does it? There we go. Right, so what we're gonna do, let's move this out, right, is you're gonna enter, let's say you're a New York trader, you've missed this for whatever reason, you're gonna enter on this fair value gap. Now for your stop, again, it's completely up to you. I would just put it at this swing high here. Let's just remove this. Right, so you've got your first easy high probability setup in London, and then again, a setup in New York with your stop here for a 5.5 pip stop loss. And then for take profit, at least a 3-to-1 like this, or just target liquidity. As simple as trading can get, right? I cannot make trading any more simpler than this. You know, if you're using the strategy and you're looking hard enough, and by looking, what I really mean is you have a watch list like I do, right? So the majors here, you've obviously got Euro, all the majors, you've got indices, you've got commodities, you've got crypto, you know, you've got the crosses, which is like GBP, JPY. Obviously, you don't need all of that, but if you've got like a collection of maybe like 10 currencies and you're just scanning through, remember, you need the 4-hour fair value gap first, right? So if there is no 4-hour fair value gap, like you do not even look at the market, right? So, but if you've got a watch list of just a few currencies or even all the majors here, Euro dollar, GBP USD, AUD USD, NZD USD, CAD, Swissy, and then obviously yen. If you just use all these and look for this setup, you'll find it. You'll find a setup every single day in one of the sessions, right? In one of these pairs. So if you look hard enough, you'll find it. And all you really need is a 50% win rate with this and a 2 risk to reward ratio. And you can become profitable and you can become rich. Okay, so for this strategy, what we need to do is we need to get the 4-hour chart. Now, we're not trading the 4-hour chart, so don't worry, but we need to be looking at a higher time frame, because if you're not looking at a higher time frame, you're trading blind, right? Smart money are using this, so we need to be using this. Now, you can use this strategy on any market, literally any market whatsoever. I'm on the DAX or the German 40, just an example. I love this market. It's amazing. If you want an easy indices to trade, this is the one you want to be looking at. This is the German stock market. It is so easy, so clean. Yeah, I absolutely love it. It's one of my favorite pairs. But anyway, what we're going to do is we're going to get on the 4-hour chart, obviously, and we're going to mark the most recent order block in price action. And if you don't know what an order block is, go look at this image on screen now. It's essentially the last down close candle before the up move when you are bullish, and it's the last up close candle before the down move when you are bearish, right? So what we're going to do is we're going to mark out the most recent order block in price action, right? And this order block here, let me just mark this out. This right here, the last down close candle before the up move, is our order block. So all we're going to do is we're going to mark out the entire thing, by the way, so wicks included. It's not just a body. We're going to mark out the entire order block like this. And what we're going to do is we're just going to wait for price to come into this order block. And then once it comes into this order block, we're going to get onto the lower time frames. Now I'm going to show you this on the 15-minute, but you can use any time frame that's less than the 4-hour chart. So let's get on to the 15-minute here, right? So here we zoom out. This is this big 4-hour order block that we just talked about, right? And do you know how I said we wanted to wait for price to hit it, right? And that's what we saw on the 4-hour chart. What we want to see now on the lower time frames, actually, let's just mark this out. Right, price has hit this order block again. What we want to see is we want to see price shoot off, give us a retracement, and shoot off again, right? Now, what that really is this is confirmation that we're on the right side of the market, right? There are so many order blocks that fail. There are so many fair value gaps that fail. And the reason why is because you don't wait for confirmation. We need to see price respecting this order block. And the easiest way to see that is just look at this, right? Here's a massive order block. Price barely goes in. It instantly shoots off. Here's your retracement and shoots off, right? This right here is what we call respect of an order block. The fact that price, let me just remove this actually. The fact that price taps into this order block, instantly shoots off, that is telling us, that smart money screaming, not at us, but at themselves and other traders, that this is a bullish market, right? This order block is being respected and this market is about to shoot off, right? This is how you know and how you get high probability trades. You always wait for confirmation. You don't just blindly buy at an order block. You don't just, blindly buy at a liquidity sweep. You always wait for confirmation because confirmation is king. This is how you get a high probability setup, right? So price hits this big 4-hour order block on the 15-minute chart and then it instantly shoots off. Right, it instantly shoots off. Now for this strategy, and it's really easy to make money with this strategy, really easy, especially on the 15-minute chart, is you're now on the lower time frame. So like I said, any time frame less than the 4-hour chart, you can use as your entry. But the 4-hour chart, you must use. You do not change the 4-hour chart. If you change the 4-hour chart and you start using the 1 hour and the 15-minute, this strategy will not work. Or I can't guarantee that it will work, right? But if you use the 4-hour chart and the lower time frame, this will work, right? This will work almost all the time, right? It's insane. So now that price has hit the order block, the 4-hour order block, and has shot off, what we want to do now is we want to mark the new order block that forms in price action. So if you remember, bullish order block, the last down close candle before the up move, this is our new order block here. Right, this new order block here, and this, let me just mark this out clearly, this is going to be our new entry. Now, if you almost remember price action on the 4-hour chart, you'll remember the order block was also like a doji candle. Do you remember that? The order block was also like a doji candle, and the price action here is very similar to what it was on the 4-hour chart. This is what people mean, and ICT means when he says price is fractal, right? The exact same price action on the daily 4-hour chart is what you'll see on the 5-minute, 15-minute, 1 minute, any time frame, right? So we're going to mark out this new order block, and this is going to be our entry. We have our confirmation. Price has hit the order block. It's shot off. It's shown us it's respecting the 4-hour order block. Smart money are buying. We're bullish, right? We're bullish. The market's screaming at us that we're bullish. All we need is not a new, but just a simple entry. And just by waiting for, let's just remove this, right? Just by waiting for an order block, we can enter on this. So your entry is going to be at the order block. Stop. It can either be at the order block low or just put it at this swing low here, right? Basically the same thing. Right, basically the same thing like that, right? And then what we're going to do is we're going to zoom out. And for those who know, you've kind of got your liquidity sweep here. Now, again, I'm not going to talk too much about liquidity, but can you see how price takes out liquidity here and here and goes into the 4-hour order block, shoots off, entry, bam, right? Insane. So if you understand liquidity, which is simply stop loss orders, and you add it to this model, you can make all the money in the world. And here's another golden nugget, right? The highest probability order blocks will always form after a liquidity sweep or a stop run, right? So you see here, price drops massively. I mean, look at this, right? Price is not dropping for any random reason, right? It drops during London session, during the open, takes out liquidity, big 4-hour order block, shoots off, confirmation, easy entry, right price up, right? Easy entry. This is how you actually read price action and make money from it. So our entry at the order block, take profit. For me, it's always a minimum 3 to 1. You can target this high here for an easy 3.35 risk to reward, or you can target liquidity all the way up here, right? Now, if you're a day trader, you want to, at most, you want to target at least previous day's high, which is here, right? You don't want to, put your take profit all the way up here because, price can literally hit your take profit and then just stagnate. And this is Friday's price action. So we're pretty lucky that price came all the way up and took out, what's this, Asia's high, London's high right here. But beautiful piece of price action. London drops, takes liquidity, hits the order block, shoots off, easy entry, right price up. You can do this on the 5-minute, 1-minute chart, any time frame, does not matter. As long as you've got the 4-hour order block, as long as you wait for price to hit the order block on whatever time frame you like, shoot off, that gives you your confirmation, enter on the new order block that forms, and then ride price up to whatever take profit you like. If you do that, you'll become a consistently profitable trader faster than you could ever realize. Now, the reason why the strategy actually works is because it's founded on logic. It's founded on the only reason why these markets move, which is simply for liquidity. Now, for those who don't know, liquidity is stop loss orders. They're the exact same thing. And these markets are only going to move for where the money's at, right? It's only going to move for where smart money, Goldman Sachs, big banks, hedge funds, central banks can get into and out of their positions. So what I'm about to tell you here works on every single market imaginable. It doesn't matter whether you live in India and you trade the Indian stock market, it's going to work, right? If you can find it on TradingView, this will work because, like I said, all markets move based off liquidity. If it's listed on an exchange, it moves based off liquidity. Even penny stocks, for the person who was asking. So now that we've got out of the way, what you're going to do for whatever market you trade is you're going to get onto the 4-hour chart, right? And you're going to ask yourself this almost stupid question, but trust me, this works, right? So let's just imagine you're on the charts at this point right here. You're simply going to ask yourself this question: is price most likely at this point here to continue upwards and take out this high here, where there would be lots of stop loss orders, lots of liquidity? Remember, support and resistance, people are going to put their stop loss there. Is price most likely to do that, or is it more likely that price is going to come all the way down here and take out this low here, or even this low here, right? Let's just remove this. Which one's more likely do you think to happen? Right, no one knows for sure. No one has 100% win rate, but what's more likely to happen? Is price more likely to go for this high, or this low, or this low? Right, hopefully, pretty obvious price wants to go for this high. Now, if you're ever struggling with liquidity and determining, which high or low to actually look at, simply use the indicator. It does it all for you. But like I said, right, the indicator will add to the win rate, but again, you can become profitable using this with just naked charts. But essentially, which high or which low is price most likely to go for? Very, very unlikely that price is going to come all the way down here and take out this liquidity. Very likely that price is going to go for this liquidity here, which is a 4-hour high and a daily high, right? Buy side liquidity. Again, terminology does not matter, right? All we need to know is that price is most likely to go for this high here, right? So we have our first step in this 3-step formula, which is going to be bias, sweep, entry. So the first thing we always need is our bias. Now this right here, this almost weird question of which high or low we're going to go for, has given us our bias. We know our bias, we know our likely direction for the market. What do we need to do now? We need to get onto our entry time frames and we need to look for a sweep. Okay, so here we are on the 5-minute chart, right? And let's just imagine you want to trade the 5-minute or even the 1-minute chart, because I'm going to show you the entry on the 1-minute chart. Now here's that big daily liquidity, that 4-hour high that we were talking about, all the way over there in price action, right? What we just talked about. Now remember, our bias is bullish, right? Price is very likely to go towards this high. Like we said, very unlikely it's going to go all the way down for that low. However, just because we're bullish, we cannot simply just buy the dip on a fair value gap and ride price up. If trading was that simple, I wish it was. If it was, we would all be millionaires, but that's not the case, right? Instead, we need to wait for something called a liquidity sweep. Now, if you don't know what a sweep is, go look at this picture on screen now, which explains it. It's probably the hardest thing in trading. Like, I'll be honest with you, it's probably the hardest thing in trading. It took me years and years and years to actually fully understand it. And essentially what it is is when you're bullish, which we are, right? Remember, bias is always number one. That's why the three-step formula is bias, sweep, entry. Bias is always number one. Now that we're bullish, what a bullish liquidity sweep looks like is this. Price goes up, it goes down just below an old low. It doesn't go massively all the way down here. It goes just below an old low. It quickly shoots off in the opposite direction. It does not need to be a market structure shift. So price could, let me just make this clear, price could be down here or down here. And then what happens is price will come down and give smart money traders a high probability entry and ride right off. The price will shoot right off towards the liquidity target, right? Now this is why, let's imagine you enter on a fair value gap here and it fails, but then another fair value gap works, right? This is why some fair value gaps and order blocks fail, others work, because you don't wait for a liquidity sweep. We need to be waiting for a sweep, which is simply a stop run, right? We need to wait for stop runs to be raided, purged, grabbed, whatever you want to call it. We need to wait for a stop run before we enter, because this gives us the highest probability setup in all of trading, right? There's nothing more, there's nothing that has a better win rate than this, because this is actually rooted on logic, right? Real logic on how these markets move. So, and the whole point of waiting for a sweep is so we know we can enter in a high probability trade, we can put our stop at a very, very safe area, and then we can target liquidity, right? That's the whole point, right? If we put our stop here on a fair value gap and we're bullish, and we want to buy the dip, price will come, take out our stop loss, and go straight to take profit. So that's what a liquidity sweep essentially is. Now, this is a fairly difficult example. Let me just remove this. And I always like to give you difficult examples, because if you can understand difficult examples, you will understand easy examples. And when easy examples come, you'll make a lot of money very, very quickly. So here we are in price action. Can you see any sort of liquidity sweep around here? Can you see any sort of low that gets taken and price quickly shoots off? Now, there's not really a retracement here, which is why I'm going to go into the 1 minute chart and show you it. But if you look at this bit of price action here, now I know it's messy, but again, like I said, it's a difficult example. So if we look at this price action here, let's just remove the indicator and let's just turn this off. I want to show you how to do it in like just naked charts, right? So if you don't have the indicator, this is how you would do it. Let's make this clearer too. You see our price. Now remember, most important thing is we are bullish, right? If we were not bullish, right now we'd be gambling. We have no idea what price is likely to do next. But because we're bullish and we know we're targeting that major high on the 4 hour chart, this is why this works. So we have this low here. Price goes up, just takes out this low, only slightly, and then quickly shoots off in the opposite direction. That right there is our sweep. Right now, again, if you struggle with sweeps, simply just get the indicator up like this. Let me get the settings up. Go down and make sure you've got bullish regular sweeps and fair value gap sweeps enabled. Now it's bullish because our overall direction is bullish, right? So really, really important to understand that. And we'll keep liquidity on actually. Yeah, we'll keep liquidity on. So again, here's the 4 hour high that we talked about right at the beginning. So we have our sweep, right? We have our sweep. So the 3-step formula: bias, tick, sweep, tick. Now we just need our simple entry. So what we're going to do now is, now that we've got our sweep, is we're going to get onto the 1 minute chart. And we're going to start looking for our entries. Okay, so here we are on the 1 minute chart now, because I want to give you an entry on the 1 minute. And here is essentially the liquidity sweep that we talked about on the 5 minute chart, but shown on the 1 minute. So price goes down, goes up, takes out the low. Remember how I said we want to see price go just below the old low, shoots off, and gives us our retracement. Now, obviously, this isn't a crazy, huge move in price action, and price quickly goes down. But again, this is realistic for trading, right? This is what you're going to get. So here's our sweep. At this moment right here, once there's a sweep, we want to start looking for our entries. And like I said, the indicator will plot it for you. However, if you're not using the indicator, what we want to see is we want to see the first bullish fair value gap that forms in the opposite direction, right? In the bias direction. Like 4 hour high, which is, you can't even see it, it's all the way up there, right? We want to see a bullish fair value gap form in that direction, because that is smart money, whatever you want to call them, telling us that we're on the right side of the market. A fair value gap, for those who don't know, essentially, if there's a big fair value gap, it means that price is quickly moving towards somewhere, right? It quickly needs to move somewhere. So really important. I don't think you ever hear anyone actually explaining why a fair value gap is important. It shows that price quickly, look how aggressive this is. Price quickly wants to move somewhere. So we have our sweep. We're not interested in going in shorting or selling. We're not interested in any of these bearish fair value gaps. We're interested in the first bullish fair value gap that forms. Now you can enter on this bullish fair value gap if you want. But I'm just gonna give you a few entries here. You can enter on this order block here, or you can do what I do, what Atif always does. Simple Fibonacci. Just because the fair value gap here is quite big, you'd have a fairly wide stop loss. I know it's the 1 minute chart, but again, if you can use the 1 minute chart, you may as well get a nice entry, right? Because, you know, like you can get a 3-to-1 easily on the 5-minute chart. So for me, like if I'm going to get on the 1-minute chart, I'm probably going to target a better risk reward or demand a better entry. So anyway, again, for those who are wondering, 0.705 for the Fibonacci, there's no magic in that number. It's just it's just a number in the Fibonacci that I use. And the real magic is the buyer sweep entry, right? That's the real magic. So for your stop, this is the only thing that you need to do for your entry. Your stop is always fixed at this low here that causes it to sweep, right? This low right here is what swept that low. Price shoots off, entry, right price off. You always put your stop at this low. There's no point waiting for a sweep if you're going to put your stop here, right? There's no point doing that whatsoever. And you may as well just ditch the sweep, right? But we need to wait for a sweep because we need a high probability sell. Anyway, here we are. And you're going to target at least a 3-to-1, right? Minimum, if you're going to trade the 1-minute chart, in my opinion. I know there are traders who, you know, who use a 1-to-1 and make a lot of money. But for me personally, and probably for you, you probably want to target a 3-to-1, right? So you can target 3-to-1. Or if you want to get creative, zoom out. And this is how you use liquidity, right? This right here. And for those who trade indices, this is AM session high, right? This right here, easy peasy liquidity target on the 1-minute chart. This can be your target, right? Which is crazy, isn't it? Almost a 1 to 10. How crazy is that? Almost a 1 to 10. Yeah, that's how, if you ever wanted to pass a prop firm, or, you know, you wanted to gamble, or, you know, whatever you want to do, right? You want to flip your account, this is how you do it, right? Now, I'm not recommending that. I recommend, Atif recommends you be, you know, very, very safe and do your own due diligence, right? Don't come sue me, but hey, look, listen, right? It's your money. You do what you want, right? If you want to flip an account, this is how you actually do it. Very, very high probability sell this is, but there's always the chance that you can lose. But if you've got the bias, you've got the sweep, you have a simple entry pattern, you can make all the money in the world. Okay, so the reason why this strategy works is because it's based off logic, right? You hear people say these markets move based off emotions or psychology. That's a complete load of BS. The only reason these markets move is for logic. And the real logic behind these markets is a concept called liquidity. And liquidity is as close to the holy grail as you can get into trading. And liquidity is simply stop loss orders, because those who move the markets, you know, Goldman Sachs, JP Morgan, smart money, central banks, they only care about getting into and out of their positions. And they can only do that by targeting major highs and major lows on the 4-hour, the daily and weekly. But as traders, all we need to know is, for this strategy, right, is if we get onto the 4-hour chart and we target major highs and major lows, this will give us the correct daily bias, overall, you know, direction of the market 9 times out of 10. Probably more than that, right? Almost all the time, right? Very rarely does this not work. Because like I said, it's rooted on logic, not on opinion, not on psychology, it's rooted on logic, right? The only reason these markets are moving is for logic or liquidity. So what you're going to do, and this might sound stupid at first what I'm about to tell you, but trust me, it works, right? You saw all those people, there were literally hundreds of people, or thousands, right, who have become profitable using this. So just bear with me, right? It might sound stupid, but what you're going to do is you're going to get onto the charts, right? And let's imagine you're on the charts at this point right here in price action. What you're going to do is you're going to mark out the most obvious or the most recent high or low in price action that's still intact. Now, what I mean by that is you're not going to mark out this low here because price has already broken through it. Right, I hope that makes sense. We're not going to mark out this one. We're going to mark out the most recent 4-hour low that's still intact. So not this one, but this one right here, right? Oops, let's get rid of that. See how price leaves equal lows? So this low right here and this high right here, these are our major highs and major lows in price action. And what you're going to do is you're going to ask yourself this simple question, and it might sound stupid, but you're going to ask yourself, at this point right here in price action, are we more likely to come all the way up and take out this high here, or are we more likely to just continue downwards and take out liquidity at this low and this low here? Right, it's not a trick question, and again, it sounds stupid, but hopefully pretty obvious price wants to go for this low. Now, why does it want to go for this low? First of all, there's no respect of any order blocks or fair value gaps whatsoever, right? If there was, price would have tapped, let's say, this order block or fair value gap and shot right off. We do not have that whatsoever. But more importantly, we have so much liquidity, right? We have so many stop loss orders. And like I keep saying, the only reason these markets move is for stop loss orders, right? And the reason why is because it allows smart money to get into and out of their positions. The only reason these markets are moving, not for me and you, for them, right? These markets are highly manipulated in every way, shape or form. And there's really 2 options you have. You either copy what smart money does and make all the money in the world, or you go against them and, you know, this is why 95% of traders are unprofitable. They go against smart money and they just lose, right? So we're going to copy smart money. And the good thing is, bro, they're making billions every day. You can be making $1 million a month and it means nothing to them whatsoever. So we're going to copy what smart money does. And this is what they're going to do, right? They're going to target highs and lows to get into and out of their positions. So hopefully that makes sense. I feel like if you have the understanding and logic behind why you're actually using the strategy, when you go on an inevitable losing streak, you'll push right through it because you know this is why the markets actually move. So this right here, targeting this liquidity, this gives us our bias, our direction, which is the most important thing in trading. If you don't have a bias or direction and you're just randomly buying because of VWAP or market structure or an indicator, you're basically gambling at that point, and you're gonna have a tiny win rate and barely be profitable, if profitable at all, right? So we've got bias, which is the most important thing. Step 2, which is always missed by all traders, is we're gonna look for a liquidity sweep, which is so important. So let's get on to 15-minute chart, and let's just remove this blue line, right? Because obviously price, it still can do this, but obviously it's very unlikely, unless there's like some sort of major news event in the Middle East or something. Very unlikely price going to take out this high here, right? So here we are on the 15-minute chart. We know price wants to go for this low here, right? This 4-hour low that we've marked out, right? Now, the markets are not as easy as this, right? It's not as easy, as buy the dip, sell the rally, and ride price down. If it was, I mean, let's be honest, right? You get the bias right most of the time, right? The bias, you can, it's pretty easy to identify what I just did in the 4-hour chart. It's pretty easy to do that, but you get the bias right, but you're still not making money. And the reason why is the markets do not move based off this, right? You cannot just sell on a fair value gap. Even if you are bearish, right? You can't just sell on a random fair value gap. Like, look at this, right? We have a fair value gap here. Price smashes right through it. Why does it do that? The reason it does that is because we haven't waited for something called a liquidity sweep. And you hear so many different names for this, liquidity sweep, purges, run, grabs. Everybody calls it slightly different. And they have a slightly different way of saying sweep. This is what I mean when I say liquidity sweep, right? So you know how we have the old sell the rallies, buy the dip, right? What we really want to see is we want to see price come up, just take out an old high when we are bearish, then shoot off in the opposite direction. It does not need to go below this old low. There does not need to be a market structure shift. We do not look at market structure. We do not need it. It's a distraction, right? So price could either do this and then start reversing, or it could come all the way down. Does not matter, right? We don't need to wait for a market structure shift, right? And then we wait for price to retrace, and then we enter on our fair value gap, order block, VWAP, indicate, whatever you like, whatever indicator or pattern that you like, after you have the bias and the sweep. This is what smart money does, and then they ride price down. Before every big move, there will always be a liquidity sweep. It's just the way these markets are. It's the way these markets are coded, right? So if you know, you know. Right? And again, smart money, their algorithms are coded to trade like this. The reality is, if you're moving billions into crude oil, you're not just going to market buy and sell. You have to take someone's place. You're going to have to take someone's place. And the only way you're going to do that is by targeting stop loss orders, right? Like I said, markets move based off logic, not personal. It's just business, right? They don't care about me or you. If you've got your stop there, you're going to lose money. However, if you enter on this order block afterwards, you're going to make money. Smart money could not care less about me or you, which is a great thing, right? Because we can make money consistently by just copying what they're doing. So you probably want to take a screenshot of this. Maybe I'll put a nice graphic of a bearish liquidity sweep on screen now that you can just take a picture of, put it on your wall, and master that, because you'll see it everywhere in price action. It's actually insane. Okay, so now that we know what a liquidity sweep is, in theory, we need to look for it in price action. Now, can you see price? And remember, most important thing is that we're bearish, targeting this 4-hour low that we talked about, right, at the beginning of the video. Now, can you see price coming down, taking out stop loss orders, dropping, a little bit of a retracement, and then going down? Right? Can you see that anywhere in price action? I always say this, but I'm literally marking out here, right? So, sweeps tend to be the hardest thing that people struggle with. So again, if you struggle with liquidity sweeps in live price action, you're not alone. And I'm working on building a custom indicator, which I'll talk about in probably the future video, which actually plots sweeps and liquidity for you, which is insane, right? I've got a team of developers working on it. But anyway, right, see this here, and again, it does not matter what high or low gets taken, right? This right here is London's high and low, and it's also Asia's high and low, and it's also previous days highs and lows. So tick, 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 right? Tick all those boxes. It really does not matter. Any major, like this high could have done, right? If price took out this high and then dropped and then gave you a retracement, does not matter, right? I'm not going to say, oh, it has to be previous session's high does not matter. Any major high or low will do. So here we go, right? So this right here is just liquidity, right? It's just some stop. Some people are shorting crude oil. They have their stop loss orders here, and they know price wants to go for this low. But again, they're trying to sell the rallies, and then also when price starts to retrace, people are entering on fair value gaps, order blocks. Smart money punishes them, takes their position, and then rides price down, right? Just the way these markets move. Nothing personal, just the way these markets move. Now, can you see this, right? See this? See, this is how you know it's a sweep. Now, it's not always a wick, but can you see how obvious this is that it's a fake move, right? We've got liquidity at these highs here. What does this wick do? Shoots right up, takes out anyone who had their stop loss orders around this level, because obviously not every trader puts it exactly at this high, right? Some of them, I remember when I was trading support and resistance, they would say, give it breathing room. Do you remember that? Breathing room? What the hell does that mean? They're still going to get hit, right? This wick goes up just enough to make sure anyone who had their stop loss orders around this area is going to lose out, right? Smart money can enter on their positions. It drops, it gives other smart money traders and their algorithms a retracement, which we want to enter on, and then price rides down. Now, you might hear people talk about turtle soup. This is what they mean when the wick takes out these stop loss orders. They're just shorting as price takes out stop loss orders. For me, that's very risky because you never know where to put your stop. You could be right and think, oh, okay, yeah, this is a liquidity sweep. I'm going to put my stop here, and I'm going to target this low. Price still wicks you out, right? So I always wait for confirmation because turtle soup's very, very risky, and only if you're already profitable and you want a better risk to reward, I would use it. But even then, I think it's very, very hard, right? So liquidity sweep, remember, bias first, liquidity on the 4 hour, liquidity sweep, which is on your entry time frame. I'm on the 15-minute chart. It can be on whatever time frame you use, as long as it's your entry time frame, right? So you always look for this on your entry time frame. So if you trade the 1 minute, you look for this on the 1 minute. You do not look for this on the 4 hour chart, unless of course you want to be a swing trader, which is absolutely fine, right? But if you're looking for this on the 4 hour chart and then you're going down to the 5 minute or 15 minute, that's not what we do. So here's the sweep, here's the liquidity. We have our bias, we have our sweep. All we need now is a simple entry. Now I'm just gonna get onto the 5 minute chart here, just so it's easier to actually see this bit of price action here. Okay, so here we are. Let's just move this over here. So this is the sweep. This wick here is the sweep. Price instantly reverses in the opposite direction. Now this is a fairly difficult example, just because the stop's very big. I always say, if you're struggling with liquidity and especially sweeps, just wait for a fair value gap to form in the opposite direction, because that right there will essentially tell you that this is a sweep. However, the stop is very big here, like it's a really big stop. What I would do personally is I would enter on this order block here. I'm gonna give you a second entry, which I don't normally talk about. I would enter on this order block here, and the way sweeps are is you always put your stop at the high of the sweep, because that is the highest probability setup, right? Do you know how in the beginning of the video I was saying this is a high probability setup? If you want the highest, absolute highest probability, you put your stop at this high. Now, if you want to give up, if you want to have a tighter stop, that's fine. You probably get more entries. However, you will have more losses, right? So again, trading is just trading is literally a trade-off, right? So here we go. And then what you would do is, let's say you wanted to enter here, is you would target the old low. Now, you target this liquidity for a 2-to-1, right? Now, you also do get a 3-to-1 later on, but more often than not, you're actually not going to get that. Your second entry, right? And this is a riskier entry, right? So remember, this is a risky entry. It's still fairly high probability because obviously we've got all the price action. But instead, what you can do is you see how price, let me get this up, right? Let me get the path tool up. See how price hits this order block, then reverses, then gives you a retracement, and then drops off. This can be your second entry here, right? Now remember, this is just nowhere near as high probability as having your stop at the sweep high, right? This is the safe stop loss. However, if you, let's say for whatever reason you missed your entry and price started to drop off, you see this fair value gap right here, like this, right? And also notice how there's no respect of any order block or stuff, whereas in this bit of price action, price touches this order block and then shoots off, right? We don't want to see any respect to it. In fact, price is wicking below this order block here. But again, it doesn't really matter. You can enter on this fair value gap, and then you can put your stop at this high here. Now remember, like I said, this is a lower probability setup, right? The highest probability is always having your stop at this high here, right? Really important that you understand that. So there is a chance price can take out your stop loss. But in this case, look at this, right? How much of a risk to reward do you get? I mean, obviously you always target a 3-to-1. which is what I would do. However, if you're going to take a risky setup, you may as well target a large risk to reward ratio. So if you just target the liquidity, you can get a 5-to-1. So it's really up to you what you want to do. I mean, if we just play price action, you can see it smashes through. But again, not every time are you going to get that, right? Not every time are you going to get that where you put your stop here and it gives you a huge entry, right? So those are two separate entries that you can do. You can have the sweep, always put your stop there. That is the best setup in all of trading, right? That is what I do personally. However, if you miss it, this is like your second confirmation, right? Second confirmation, your second entry, second try. It's there for you, right? If you want it, if you see it in price action, if you miss your entry for whatever reason and you see this, maybe you want to do it, right? But just be careful. This is a lower probability setup. The 4-hour chart tells you everything you need to know: daily bias, liquidity, and in this video, I'm going to show you how you can use the 4-hour chart to become a consistently profitable trader. And the first thing you want to do when you're on the 4-hour chart for whatever asset you want to trade is you want to look for the most obvious liquidity pool that price is going to go for. Now, what makes the 4-hour chart so powerful and so great is this is what smart money are executing on, right? They do their analysis on the weekly and daily chart, but they are looking to execute, and by execute I mean enter their trades on the 4-hour chart. So every single candlestick here tells a story in the 4-hour chart. This isn't the 1-minute chart, this is the 4-hour chart, right? So this is probably the most important chart in all of trading, and like I said, it tells you everything you need to know. So what you want to do is when you're on the 4-hour chart is you want to ask yourself, where's the most obvious high or low that price is going to go for? Now, hopefully it's pretty obvious at this point right here. This is the next most major high that price is going to go for, right? Price is right next to it, right next to this high. It's almost magnetized towards this high. And I'll tell you why in a minute. And it's very unlikely that price is going to come all the way down and take out this low. Now, would you agree at this high right here, there would be lots of stop loss orders? There will be lots of people who trade support and resistance who will think that price will come up here to this level right here and then bounce off and reverse. Would you agree that, let's remove this, would you agree at this level, there's probably lots of stop loss orders? Right, hopefully so, right? At this level, there's going to be lots of stop loss orders on the 4-hour chart, right? Not on the 5-minute chart, the 4-hour chart, right? There's going to be lots of money. Now, the only reason these markets move is for money or liquidity or stop loss orders. They're all talking about the same thing. If Goldman Sachs, JP Morgan, smart money, they can only get into and out of their position where there's lots of money, right? If you're buying billions, let's say, if you're smart money and you've bought billions of euro dollar down here, right? And you need to get out your position, what do you need to do? You need to sell billions of euro dollar to get out your position. Now, smart money can't just market buy and market sell like me and you do, right? The only way they can get into and out of their positions is where there's lots of stop loss orders or liquidity or money, whatever you want to call it. Now, at this level here, there's lots of money. So does that make sense, right? If smart money bought down here, that the only way they're going to get out of their position, let's imagine they bought down here, right? Is the only way they're going to get out of their position is by targeting this major high where there's lots of stop loss orders and they can get out of that position, right? Does that make sense? Hopefully it does make sense. So what the 4-hour chart is really telling us, and what's so important about it, is it's telling us where the next most obvious liquidity pool is, right? And like I was saying, the only reason these markets move is for liquidity. So this high right here, there's going to be lots of stop loss orders, lots of liquidity. This is going to act as a magnet pulling price towards this high, right? Now, what we do afterwards doesn't really matter. As day traders, scalpers, and even as swing traders, right? If you're a swing trader, you would enter on any sort of retracement, fair value gap, whatever, ride price up, right? So if you want to trade the 4-hour chart, there you go. But most people aren't swing traders. So how do we use this to make money, right? That's the only thing we care about in trading, right? We want to make money. How do we actually make money from this? So what's really important right here is this liquidity pool that we've just talked about. This tells us the direction of the market, right? We now have our daily bias, our liquidity pool, whatever you want to call it. We now have our most likely direction where price is going to go for next, right? So all we need to do is trade in that direction, right? Hope that makes sense. This is why the 4-hour chart is so important, right? It's not the daily chart where there's some, random high all the way over here in price action and it's going to take like a week to get there. Right, it's not the weekly chart, it's not the daily chart, it's the 4-hour chart. It's the most recent bit of price action, which is telling us where price is going to go for next. And price is going to go for this high here. And what we do afterwards, we don't care, right? We can make money riding price towards this high. So let's get down onto the lower time frames and look for a simple entry that we can use. Okay, so here we are on the 1-minute chart, and you would do this analysis that I'm about to tell you on any time frame that you like to enter your trade on, right? So here we are on the 1 minute chart. Now, do you know how I said that we look for an entry? There's actually a middle step that so many traders like don't even realize, and this is what held me back for years, right? You have your bias, then you need to look for a sweep, and then and only then do you look for your entry. I'm telling you, if there ever was a holy grail in trading, that would be it. Bias, sweep, entry. Super important, right? So the 4-hour chart, liquidity pool, which is all the way over here, right? That tells us the bias, but we're not going to enter our trade and start, targeting this random high, right? We need to look at the entry time frame, right? So we're looking at the 1 minute chart. The only thing we need to look for is a stop run, because these markets do not move in straight lines. And do you know how I was saying these markets only move for liquidity or money or whatever you want to call it? The exact same thing on the 4-hour chart happens on the 1 minute chart and on all time frames, right? These markets are highly manipulated and they're only designed to allow those with billions, i.e. smart money, to make money. It's not designed for me and you, but we can make money by essentially copying what smart money does, right? But has this happened to you before? And it probably has happened to you. Let's just say there's an order block right here, right? You're bullish, you've got the liquidity right, you've done the analysis, your daily bias is correct, and price comes off, and then you look to buy on some fair value gap or order block, only to see price what? Chop for a bit, and then take out your stop loss, and then go straight to take profit. Like, has that happened to you before? Probably, and this used to happen to me for years and years and years of just pain and frustration. And to be honest, those were some of the most miserable years of my life. I wanted to skip that, and the reason why I kept losing the trades despite having the right liquidity all the way over here, the right daily bias, was because I didn't wait for a sweep, right? Now a sweep is simply, or a liquidity sweep is simply a stop run. It's a fake move designed to take up stop loss orders, so smart money can get into their position and then price shoots off. And before every big move, and this is something for your notes, for every big move there will always be a stop run, right? Designed to allow smart money to get into their positions. And on the lower time frame, for those who are wondering, it's their algorithms that are trading like this. So can you see this low here? Let me move this out of the way. Oops, move this out of the way. So this right here is time, and it's always New York Eastern time for those who are asking. This is Eastern time. I live in the UK, but I still use Eastern time, right? So for those who are wondering, this is EST, right? So this right here is Asia's low. Now it doesn't really matter that it's Asia's low. Any major low will do. Now there's going to be stop loss orders here, right? Pretty easy to imagine. There are going to be people who have bought here and have put their stop loss at this low right here, right? Not that much liquidity compared to the 4-hour chart, but there's still going to be some money at this low, right? Someone's going to have their stop loss here, right? Now, can you see, and this is really important, right? Can you see this long wick? Look at this long wick here. Can you see how it goes below this light blue or this dark blue line, which is where all the liquidity is at this low? It goes just below it and it instantly shoots off in the opposite direction, right? So let's just let's zoom out a bit and make this crystal clear, right? Can you see how price does this? There's the low. Here's the major low right here. Price comes, this little wick, look at this little wick just goes below it and then shoots right off in the opposite direction. That right there, you will see over and over and over again. If you've watched a few of my videos on my channel, you'll know this is essentially the same thing I say constantly, not because I'm crazy or insane, but because this is actually what works, right? This is how I actually trade on a day-to-day basis. Look, bias, sweep, entry, right? Keep saying that until it's in your mind. But, would you agree that this wick going below this low here and then shooting off, would you agree that that's a fake move? Right, probably. Like, it probably makes sense. This is a fake move. The wick just goes below it and it shoots off in the opposite direction. Now, you might be asking, oh, Atif, what happened here? Like, was this a sweep? Was this a sweep? Well, let's see, right? Can you see how price chops for ages, right? Chops. We do not want to see that. We want to see strong, aggressive moves in the opposite direction. Now, some traders want to wait for a market structure shift. I don't use market structure. Like I said, the only reason these markets move is for liquidity or money, right? It is not because of, a body closing above an old high or whatever. But, if that works for you, that works for you. But we've got our two, complements. We've got our bias on the 4-hour chart, which is the liquidity pool, all the way up here, and we've got our sweep, right? That right there is 99% of trading done, right? You're 99% of the way there. All you need is a simple entry pattern. Now, I think after years of trading, 5 years of trading, more than that at this point, the easiest thing to do is, once you've got your bias, once you've got your sweep, is just to wait for a fair value gap to form in the opposite direction. That right there is the easiest way to know that it's a sweep, right? We've got major liquidity at Asia's low, major liquidity pool. It's not some random low, and it's a fairly significant low. Price wicks below it, it shoots off, it leaves a fair value gap. The fair value gap is smart money screaming at you that this is their entry. And the reality is, this fair value gap, the only reason this is actually here in price action is to allow smart money traders and their algorithms to get into the position, right? It's almost like I always say, right? Smart money screaming at you. They're not screaming at you, they're screaming at other traders who trade like smart money, right? They're saying, hey, get in, get in, get in. Now's the time to get in. So that's how we enter our trade, is at a fair value gap. Now, if you like your indicator or order block, by all means do that. But waiting for a fair value gap is the easiest way to get confirmation. So what we're going to do is simply enter on the fair value gap. We're always going to put our stop at the low, because there's no point waiting for a sweep if you don't have the stop at the low. There's absolutely no point, because what was the point in doing this analysis if we're going to put our stop all the way here, right? I know you get away with it this time, but what is the point, right? The whole reason we wait for a liquidity sweep is so we know it's very, very, very unlikely that price is going to come and reverse and take out our stop loss. Why? Because it's already done that, right? The only reason price came down here was to take out this major liquidity pool and shoot off. Very unlikely that it's going to come all the way down and take out your stop loss again, right? Very, very, very unlikely. So hope that makes sense. And for your take profit, so your stop is always fixed at the low. For your take profit, you're going to target, if you're on the 1 minute chart, I always say this, you should just target a higher risk reward as you can realistically get. My eyes instantly gravitate towards this liquidity pool. You know, minimum, if you're trading the 1 minute chart, minimum a free risk reward ratio. I always, those who are wondering, fixed free risk reward ratio. That's what works for me. Take profit is the easy part, right? Listen, if you're making money, how much money do you want to make? That's the easy part, right? Everyone loves money, don't we? So for your take profit, you want to target something that's actually realistic on the day, right? So don't just target blindly the 4 hour chart. Unless price is right next to it, then yeah, by all means target it. So this is easy liquidity pool right here. And if you just do this, if you just follow this 3-step process, buyers, sweep, entry, you'll make all the money in the world. Okay, so for this strategy, all we need is the 15-minute chart. And the 15-minute chart is probably the best and easiest time frame in all of trading, right? You would be very wise to spend your entire trading career mastering this chart. If you want to be a day trader, if you want to be a swing trader, do the exact same thing that I'm about to tell you in this video on the 4 hour chart. But anyway, what you're going to do is you're going to get the 15-minute chart up for whatever asset you trade. This works in every single market on TradingView, right? If you can find it, if it has candlesticks, this strategy will work. So you're going to get the 15-minute chart up. And let's just imagine you're at this point here in price action. What you're going to do is you're just going to zoom out and you're just simply going to look for the overall trend of the market, right? And we're not going to do any crazy daily bias or complicated analysis. You're just going to eyeball it, right? You're just going to say roughly, what is the overall trend of this market, right? Is it going up or down? So let's just, and you don't have to zoom out like people do this all the time. You have to go all the way back here. Just whatever trading view will allow you to fit on, or your broker will allow you to fit on. Just use this and just eyeball it, right? From this point here, where has been the overall direction of the market? Now, I know we're consolidating a bit here, and I'll explain what this actually is, because this is not consolidation, actually. This is something completely different, which I'll talk about in a minute. But what is the overall direction of the market? Right, it's bullish. Like, would you agree this is an overall bullish market? Smart money, those who actually move price, are moving this, are bullish, right? They're moving this up, right? Price is not bearish, it's bullish. So if we just remove this, that right there will give you the correct daily bias 9 times out of 10. Like, I'm not even joking. You probably want to write that down. Just looking at the 15-minute trend will give you the daily bias 9 times out of 10. It's insane how accurate that is. So this is the first thing. This gives us our bias right away. No weekly chart, no 4 hour, no daily. Just the 15-minute chart. This gives us our bias for this trading strategy, right? Now, obviously, the overall time frame market, you're going to have to use a daily and weekly, but for this strategy, all we need is the 15-minute trend. So that's the first and most important thing. We are in a bullish market, so we're going to look for longs, right? We're going to study this entire price action under the premise that we are bullish and that we're looking for longs, right? So that was the first part. Right, looking for the 15-minute trend, that's your bias. Now, there's only really one concept in trading that you need to master, and that is liquidity, right? That is probably the holy grail in all of trading. There is nothing else you need in trading apart from liquidity. Obviously, you know, if you want to do mindset and psychology, completely different thing, but for technical analysis, liquidity is the only thing you need, right? Genuinely the only thing you need, and liquidity is simply stop loss orders, right? major highs and major lows on all time frames, but in particular, the higher time frames. There will be so much money, so many stop loss orders there, and that's what smart money will target, so they can get into and out of their position. That is the only reason why these markets move, right? It moves to where the money's at. It moves to where Goldman Sachs can get into and out of their position, right? If you're moving billions, you can't just randomly market buy. Let me just read this. You can't just randomly market buy and market sell, right? You have to target stop loss orders. So the only reason these markets move is for stop loss orders, right? Now I'm not going to, justify that. And there's actually a private training in the pinned comment down below where I talk way more about everything that you need to become a profitable trader. So go check that out. But all you need to understand is that these markets only move for stop loss orders, and liquidity can be broken down into two parts. The first is pretty easy, right? It's just target highs and lows, right? Target where there will be stop loss orders. The second part to liquidity, which everybody gets wrong, is liquidity sweep. So the way these markets will move, right? And this entire price action is manipulation, which I'll talk about. The way these markets move, it's not, you heard this so many times, right? Buy the dip and ride price up, right? Sell the rallies, buy low, sell high, right? The markets do not move like this, right? I mean, you can just zoom out. We know we're in a bullish market. We agreed earlier, this is an overall bullish market. Look at the price action here. Is this what it does? No, it's very jagged, right? There's lots of little lows taken out. There's lots of manipulation, right? And how the markets really move in a bullish market, it's not the buy the dip, it's this, right? The markets will move, it will take out stop loss orders, price will shoot off. It does not have to go above this high. There doesn't need to be a market structure shift, right? We do not need market structure at all. But what will happen is price will take out an old low, it will shoot off in the opposite direction, and then it will give smart money traders their entry on a fair value gap, order block, Fibonacci, VWAP, whatever they want, and then ride price off, right? This right here is, you want to screenshot this and you want to study this, right? This is a bullish liquidity sweep, right? This is how the markets move, right? They move for stop loss orders. They do not just move nice and clean for you to get your entry and, shoot right off to take profit and you pass your profit, right? If it was that easy, we would all be profitable. But let's be honest, you've probably been trading for at least a few months, probably a few years, and you're still not profitable because the markets aren't this easy, right? So ignore anyone who says the markets are this easy, right? It's not that easy. We all know that. Now, we know we're bullish. We know we're looking for liquidity. What I want to explain now is this bit here, because this is going to confuse so many traders, right? They're going to think, oh, Atif, we're bullish. Like, why is the market consolidating? So the way these markets move, and you might hear this be called, accumulation, manipulation, distribution, or power of three, all these weird names, but I'm just going to explain it how I explain it. So when the markets are bullish and smart money are moving price up, right? When they're moving price up, price will not just go up forever, right? For every buyer, there needs to be a seller. So if smart money are buying billions, they need people who are shorting Euro GBP, right? So the markets aren't just going to move cleanly. And what actually happens here, instead of the market just shooting right off, is there's not enough liquidity right at this point here. I mean, look at this. Who wants to short? Let's imagine you're on price here. If you're like a hedge fund, who wants to short here? Nobody wants to short. Everyone knows it's bullish at this point here, right? Nobody's looking for short. So what smart money does, if we just study this bit of price action, what they'll do in a bullish market, right? Let's say price shoots off, is they will give the illusion that price has hit all-time highs, or it's consolidating, or it's reached the top, and they'll even let price drop a bit, taking out liquidity, which is really a sweep, probably going into some gaps or order blocks, and then price will shoot off. It won't take out the highs, it will give smart money their retracement, and then it will shoot off. And you'll see this in every single market. What really happens is smart money is accumulating, generating liquidity, inducing people, whatever you want to call it. They're essentially just creating stop loss orders. And you will see this in indices. You see this in gold, right? Both of those markets, as I'm recording this, we're at all-time highs, right? Look at what price does. It will take out all-time highs, then it will start consolidating, then it will drop a bit, taking out stop loss orders, then it will give smart money their entry, and then it will shoot off, right? You can see that in gold, and you can see that in indices if you go on the 4-hour chart, right? But anyway, all we need to know is we're still bullish, and this right here is just manipulation, right? This is just generating liquidity, right? So the first thing we want to look for in this strategy, right? And remember, we are bullish overall, is we want to look for a liquidity sweep. And because we're bullish, we're only going to look for a low to be taken out, right? What we want to see, and do you remember how I was saying that you probably want to study this thing in price action? Price take out a low, shoot off, give you a retracement, and then ride price off, right? This is what we want to see in price action. And if you look at this point here in price action, can you see how price drops? Just look at the candlesticks here, right? Look at these little doji candles, tiny candles. Would you agree this is a very weak move in price action? Price slowly comes down And whereas here, look at how strong and aggressive this is. Big fair value gaps, huge move in price, right? Price slowly works its way down. Where does it go to? It doesn't go to some random place. It goes just below this old low here, right? Which is previous day's low. Now, it doesn't have to be previous day's low. When you're on the 15-minute chart, every major high or low is significant as a day trader. Similarly with the 4-hour and above. But this low, previous day's low, price goes just below it. Look at it, it goes just below it here. Instantly shoots off, right? Generates equal highs, which I'll talk about in a minute. Retracement, and then hopefully shoots off, right? So what this really is, right, and it's really important that you understand this. This is probably the most important part in the video, because if you can understand the liquidity sweeps, you can make money doing any strategy, right? As long as you wait for a sweep, right? What's really happened is this point right here, where price goes just below it. I mean, look at this. We spend what? Three candles below it, and shoots right off. And for those who like liquidity sweeps, here's your fair value gap entry. Stop at the low, target this liquidity pool there. Right. So for those who know about liquidity sweeps, if you know a bit more about it, here's your entry on the fair value gap. Stop at the low, target your 3-to-1, target this high. Easy peasy, right? But for this strategy, I want to give you something different, right? If you want to learn more about that, go check out this video on screen now, right? Where I teach you bias sweep entry, which is the holy grail in trading. But for this strategy, we're just going to use the 15-minute chart, right? So what this really is, this is our sweep, stop run, whatever you want to call it. Liquidity sweep, grabs, purges, all these weird names. I don't really know what these guys talk about. What I'm referring to here is a stop run, a fake move that takes out stop loss orders before price shoots off, right? That's what I'm referring to. And remember, the only reason this makes sense and works is because we have our bias, which is the overall trend for this trading strategy, right? If I did not know the bias, I'd be gambling, right? I'd be guessing where a sweep is, right? Because you could say, right? You could say, oh, Atif, this wick goes just above this high, right? Is this a sweep? Well, no, it's not a sweep because we're bullish, right? So we're not looking for highs to be taken out. We're only looking for lows to be taken out, right? If we just study this price action a bit further, we have equal highs here. And like I said, this is not a sweep because we are bullish, right? Bias is the number one thing. If you've got the bias right, it's very easy to make money, all right? If you've got the bias and you've got a sweep, very, very easy to make money. This is why I say bias sweep entry is all you need to become profitable on the technical side anyway. So we've got easy liquidity here, right? And for those who don't know or who have forgotten, liquidity simply just stop loss orders. Oops. Stop loss orders, right? Only reason these markets are moving is for stop loss orders. It's moving for where the money's at. Where can Goldman Sachs get into and out of their positions? Where can central banks, right? I mean, what's it called? The European Central Bank and the Bank of England. These two central banks have literally trillions, right? They print trillions, not billions, trillions of pounds and euros, which they want to get into and out of their position, right? If you're in Europe, this is a major currency. EU and UK, big business there, right? So the only way they can get into and out of their positions is where the money's at, right? And again, look at this, right? Look at this. Again, we've got more liquidity, equal highs. There's no respect of any order block here. This would be a bearish order block. Does this look like price has respected it when he just wicks right through it? No, right? Of course not. So we've got more liquidity and even more confident, right? Let me just do this liquidity here. Even more confident that we're bullish, right? Even more confident that we're bullish. Because if we zoom out here, remember when initially you probably saw this price action? I know it's a bit messy. You probably thought, oh, what the heck? This is just consolidation, right? There's a lot more to price action than it seems. So liquidity here. Here's the sweep. Last thing we need to do is look for a simple entry pattern. I cannot stress this enough. The entry pattern is the least important thing. Once you've done the other two steps, you've got the bias on the 15-minute chart, you've got your sweep, there's easy liquidity targets. I mean, it's almost open season. Liquidity here, there's liquidity everywhere, right? Any entry will make you money. Now, I normally say fair value gaps, but we kind of already filled it here, and this was your entry if you got that. If you didn't, which most people won't, absolutely fine. I'm just going to give you a few entries. You've got the order block here, last down close candle before the up move when you're bullish. Mark this out. Like that. Price taps it a few times. That can be your entry. For your stop, just put it like at the low, right? You don't have to have a really tight stop. Target at least a 3-to-1 or target this high. I'll show you what price does in a minute. Or you can do what I do, and this is the only thing that I still use after years of trading. It's simply Fibonacci or optimal trade entry, whatever you want to call it. 0.705 level. That's what I enter on, right? No magic in this. This is just what ICT used when I was learning from him years ago, and I just kept it, right? You can use a 0.7 or whatever you like, 0.75, does not matter. This is what I use, so pause the video, go copy the sayings, whatever you want to do, right? And then simply enter like this. For me, this is what I do personally, 3 to 1, like that. Or you can just target this liquidity here, right? Whatever you like to do. And this is the exact strategy I've used on the 1 minute chart all the way up to the 4 hour chart. And as a fun fact, if you want another one time frame trading strategy, do this exact thing on the 4 hour chart. And you're essentially a swing trader, right? Price is fractal. The exact same thing I just told you here works on every single market. Someone was asking me this, does it work on crypto, stocks, the Indian stock market? It works on every asset you can imagine, right? Anything that's traded on the stock market, it needs liquidity. It needs money to get into and out of the position. This is why liquidity works, right? It's not just some random market structure concept or VWAP or whatever, right? This is how the markets actually move, right? So it works on all markets. Use the 15-minute chart. Do not use the 5-minute chart. It will not work, or it will not be anywhere near as accurate as this. Don't use the 1 minute chart. You can use the 4 hour chart. Do not use the 1 hour chart. It will not work. You can use the daily too, you know, if you want to trade a daily chart. 4 hour chart, 15-minute chart, those two are the absolute best, easiest time frames in all of trading. Okay, so the first thing we want to do for this strategy is we want to get the 4 hour chart. Now, we're not trading the 4 hour chart, but we need to be looking at one of the higher time frames, and we need to be looking at the 4 hour chart in particular, because this tells you everything you need to know in trading. In fact, I made a video explaining why that is. But smart money, those with billions who actually move price, because it's not retail traders like me and you who are moving the market, it's those with billions, right? Banks, hedge funds, pensions, central banks, the Fed, all of these people or institutions are moving price, and they're looking, you know, at minimum, they're looking at the 4 hour chart. So we need to be doing what they're doing. So we're going to get the 4 hour chart for SPY, and this is really important, right? So if you're on trading view, if you come down here, see how it says regular trading hours and extended trading hours? Make sure you're on extended trading hours, right? ETH. If you're on regular trading hours, that will only show you price action between 9 a.m. To like 4 p.m. Eastern, and you'll miss a huge piece of price action, right? Because you can't see London session. So make sure you're on extended trading hours. But what you're going to do is you're going to get the 4 hour chart up, and you're going to mark out something called a fair value gap. Now, if you don't know what that is, you'll see a picture on screen now, which shows you what it is. All it is a simple pattern, right? And I say pattern very hesitantly because, you know, patterns don't make money, the logic does, and I'll explain the logic in a minute, right? But it really is, this is what a fair value gap is. It's the gap between this wick high here and this wick low here, right? This is what's referred to as a bullish fair value gap. And look at this, I mean, almost beautiful. You can see price fills it entirely and then shoots off, right? That is what we call a bullish fair value gap, and you'll see them everywhere in price action. But this alone will not make you money. The logic does. Now, for this strategy, this is all we need to do on the 4 hour chart, right? All we're really waiting for is we want to see price hit this fair value gap, and then on the lower time frames, we want to see price shoot off. That right there will tell us that we're on the right side of the market, essentially. So let's remove this, and now that we know that price has hit this fair value gap, let's get onto the lower time frames and start looking for our entry. Okay, so here we are on the 1 minute chart. Now here's the 4 hour fair value gap that we were just talking about before, right? This big green box, this is the 4 hour fair value gap. So here we are, this is what price action will look like. I'm on the 1 minute chart now. Someone was asking me, you know, a lady was asking me, does this work on the 5 minute, 15-minute chart? It works on any time frame that's less than the 4 hour, and because you need to use the 4 hour chart as your higher time frame. But anyway, what we want to do is we essentially want to see this, right? We want to see price hit this fair value gap, shoot off, give us a retracement, and then ride price off, right? Because that right there, right, price hitting this 4 hour fair value gap, moving off in the direction of this fair value gap, and then giving us a retracement. That is confirmation that we're on the right side of the market. Now, what I mean by that is it's not enough to just randomly buy the dips and sell the rallies, right? Clearly, if you've been in trading for more than a month or two, you'll know that's not going to make you money, right? That does not make money at all, right? We need to have a bit more confirmation. And this is the best way of confirmation, because this 4 hour fair value gap is what, you know, smart money, you know, those institutions that we were talking about, central banks, the Fed, Goldman Sachs, all of them are looking at this, right? And they want to see what price does. So when price hits it, shoots off, gives them their retracement. That is smart money, those with billions, screaming, not at us, but at other traders, hey, look, get into the position, right? And we want to ride price with them, because the reality is, if you want to become profitable, you copy what the big guys are doing, right? You do not fight, you know, you don't go against the tide, because if you do that in trading, you're going to blow your account, right? So here's the 4 hour fair value gap. Now, for this strategy, I just want you to make money, right? I'm not going to teach, theory. Let's focus on how we can make money. So when you're trading SPY, this is something for your notes. The first 30 minutes of the open, and what I mean by that is 9:30 a.m. Eastern till 10 a.m. Eastern will always be a fake move, right? Always be a fake move without hesitation. I mean, and this right here, right? So this big red candle, look at this thing here, right? That right there is 9:30 a.m. This is a 9:30 a.m. candle, and let's find the 10 a.m. candle. Where is it? Here we go. I mean, look at this. Almost, look at this. Almost perfect, right? So this is the open, and this is 10 a.m., right? This red candle here is 10 a.m. And do you know how I said it was a fake move? Right? It's always a fake move. This right here is a massive fake move. Price hits the 4-hour fair value gap, shoots off retracement, and shoots off, right? But the key thing is, and this is what you really want to pay attention to when you're trading SPY or any indices, is you want to skip the first 30 minutes of trading. Now, I know that's not what you want to hear. As soon as I started trading, as soon as the market would open, I would buy and sell. That is not what you want to do, right? That is not how professionals trade. Wait till 10 a.m. Eastern. The first 30 minutes is retail, it's gambling, it's a fake move. Just wait till 10 a.m. Eastern, right? Now, once it's 10 a.m. Eastern, and we're in this big 4-hour fair value gap, what we want to do for our entry is we want to wait for another fair value gap to form, right? Now, you'll see what a fair value gap is on screen now, right? You can see the little image of what it is. And we talked about it before, right? So we've got the 4-hour fair value gap. At 10 a.m. Eastern, we want to look for a new fair value gap to form on the 1-minute chart, right? Which is bullish, because that's going to tell us we're on the right side of the market. So there are a few fair value gaps that form. Right, we've got one here. Let me just mark this out for you. We've got one here, which is a very small one. Gap between these two candles here. We've got another one here, like this. And can you see how the wicks fill it like perfectly? Can you see that? Like, it's crazy. Like, this stuff actually works, right? It's not some random indicator. This stuff actually works. And this is 5 years, more than 5 years of trading knowledge to get this, which is pretty sad. That's a lot of hours I put into this. But anyway, right? We've got fair value gap here, fair value gap here, right? So either one of these will be entries. Now I'll tell you where to put the stop loss, so it doesn't really matter. You can enter on this one, you can enter on this one, but you got to think, this is the 1-minute chart. And when I was trading the 1-minute chart, I would miss entries, right? Because as soon as this fair value gap would form, this wick instantly drops in. Are you going to be there in time to buy it? Are you going to mess up your order? That sort of stuff. So the easiest one for me, and any one of these are valid, but the easiest one for me that just screams out at me, see this big juicy fair value gap, right? See this big fair value gap here. Big fair value gap like that, right? It's a bit choppy here. Big fair value gap with a few candles. It gives us time to put our entry, to put our limit order up, to get our broker up. We're not rushing around. This is what I like. And like I said, any one of these entries is fine, because you're going to enter on the fair value gap like this, and you're going to put your stop. So there's no hard rule. If you know about liquidity and liquidity sweeps, which you don't need to become profitable, although it will increase your win rate massively, you'll know I always say to put your stop at a liquidity sweep low or a stop run low or high. And for this model, just put it at the most reasonable low, which for me is this, right? Very safe stop loss if you've got it here. So if you entered on this fair value gap, just put your stop here. Same thing here, right? You don't need a really tight entry, right? When you actually understand the logic of the market and you've got the direction right, you can have a wide stop loss and make all the money in the world, right? It's these guys who have terrible win rates, 20% win rates with these indicators, who need insane risk to reward ratios and tiny stops. But anyway, right? So this is the 4-hour fair value gap. Let's zoom out. Here's the 4-hour fair value gap. Our entry is the first 1-minute fair value gap platforms. Now, like I said, we could have chosen any one of these. It's a bit choppy here. This is just, my eyes just saw this instantly, right? So, if you miss this, you can enter on here, but it doesn't really matter, right? So here we go. Stop here. Now, for your take profit, for me, I always target a fixed free risk to reward ratio without hesitation, because after 5 years, well, 5 and a bit years now trading, this is like I don't want to say holy grail, but I think it's the optimum risk to reward. It balances win rate and like actual money that you make from the markets, right? So for me, I always target a 3-to-1. If you like a 2-to-1, 1-to-1, by all means go and do it. If if you know about liquidity and you want, okay, Atif, where's the most reasonable place to put my take profit? If I want to make as much money as I can on the day, like where should I actually put my take profit? See this high here? This is referred to as the pre-market high. So anywhere between 7 a.m. Eastern to 9:30 a.m. Eastern is really the pre-market high. Now you have London session high and low, which is before that, but pre-market is 7 a.m. Eastern, and this right here, by the way, is New York Eastern time, right? 7 a.m. Eastern till 9:30 a.m. Eastern is the pre-market session, right? Just before the market opens, there's always a bit of trading. But anyway, you want to target that high, right? Because there's lots of liquidity, which is simply stop loss orders, because the only reason these markets move is for liquidity and to fill these gaps, right? These gaps essentially are entry patterns, but I talk more about liquidity in a separate video. But this is literally all you need to do. 4-hour fair value gap, wait for price to hit it, shoot off, give you a retracement, and then ride off the take profit. So let's just zoom out and see what price actually does. So we smash right through it, easy take profit. If we just get out of replay mode, you can see price just smashes right through these highs, because like I said, the only reason these markets move is for liquidity. 99% of trading psychology is complete BS and will keep you unprofitable forever. However, what you're going to learn in this video will honestly change your life. Now, I know every YouTuber, every guru says this, but I can honestly say this because I spent $10,000 to get access to this information that you're about to hear in this video. So buckle up. I guarantee you this video will completely change your life. Okay, so if we're going to fix your trading psychology, we're going to have to fix your mind. And instantly, you can just see right away, this isn't going to be a normal video, right? I'm not going to give you some useless journaling advice. I'm going to teach you exactly how to fix not only your trading mindset, but how to actually become rich, right? So make sure you like and subscribe. This is an amazing video. So here we go. Your mind is divided into two parts. You have the conscious mind and the subconscious mind. Now bear with me for 2 minutes here, because at first it's going to sound intense, but once you know this, everything in your life will change just like that, right? When people say trading click, this is what they mean, whether they know it or not. So you have your conscious mind and your subconscious mind, right? Your mind is divided into two parts. Now your conscious mind is the logical part of your mind. This stores all your trading knowledge, your knowledge of liquidity, daily bias, your trading strategy. And let's be honest, right? If you're watching this, you probably understand liquidity. You probably understand daily bias. You probably have a strategy that you back tested, but for whatever reason, you still can't make money, right? Because there's more to trading psychology than just, your strategy, right? And the second part of your mind, the subconscious mind, this is the emotional part of your mind. This stores all your emotion, your FOMO, your fear, your greed, right? So we have two parts. We have the logical mind that has your trading strategy, all your knowledge. And then we have the second part, the emotional mind, which stores all your emotions, right? Now you might be thinking, okay, Atif, why are you telling me this? Like, why should I care? This right here is the big takeaway from this video, right? And you need to understand this. Let me actually get this highlighter up. 95% of your actions come from the subconscious mind, right? 95% of what you do comes from the emotional mind, not the logical mind, not your knowledge of ICT or liquidity sweeps. It comes from the emotional mind, right? 95% of your actions come from your subconscious mind. Now, what does this really mean, right? So this is your mind. We have a conscious mind and a subconscious mind. Your actions are coming from the emotional mind, right? So think about you following your trading plan, right? That's an action right there. Be honest, are you, logically following your trading plan, or are you following it based off emotions, right? If you go in a free fall losing streak, you blow the account, right? You change strategies. Why is that? Why is that? Why is it that you backtest, you've proven that you've got an edge, but you still lose money in real markets? You still, strategy hop, right? You're afraid to lose, right? You can't stick to your rules. You're supposed to risk 1%, but you're risking 2%, 3%. You're blowing prop from accounts when you know you shouldn't be, right? You can't stick to your rules. And it's all because of the subconscious mind, right? So just to quickly recap, before we actually go on to the solution, we have a logical mind, which stores all your knowledge of trading, so liquidity, your strategy. Then we have an emotional part of your mind, which has all your fear, your greed, your childhood trauma, all your past experiences. All of that is in the subconscious mind. And we just learned that 95% of your actions, i.e. 95% of your results, are coming from the subconscious mind, right? The part that has no idea about trading, the emotional part of your mind, right? And until you fix this thing right here in your subconscious mind, nothing will change and you will be in poverty forever. And this happened to me for 5 years, literally 5 years of working 7 days a week, doing everything I could, and I was still poor, right? For years, even before trading, right? All these failed businesses, years and years and years, all because my subconscious mind saw me as poor, had all this deep-rooted trauma, which comes from childhood. Let's be honest, you probably grew up in a household where people said, money's hard, money's hard to make, money doesn't grow on trees, do I look like I'm made of money, we don't have money, all this sort of crap goes into your subconscious mind and it's deeply embedded in there, right? And we have to reprogram your subconscious mind Otherwise, you will never become profitable. And some of you might be wondering, oh, Atif, does this apply to everything in life? Absolutely. Like, you can forget trading. You can put, just making money in general. Some of you are shy. The exact same things here. Deep-rooted trauma, deep-rooted beliefs in your subconscious mind are holding you back and control 95% of your results. And the reality is, deep within your subconscious mind, you see yourself as someone who isn't a profitable trader, right? You see yourself as someone who's trying to learn how to trade. Now, you might be thinking, Atif, okay, well, yeah, like, I'm not profitable. I'm trying to learn how to trade. What's wrong with me saying that? Your subconscious mind only understands right now, right? It only understands right now. It doesn't understand the future. It doesn't understand the past. If you're religious, the subconscious mind is referred to as your soul, right? It's your connection to God. God doesn't understand the future. God doesn't operate in the past, he operates right now. So when you say to yourself, I'm learning how to trade, your subconscious mind will take you literally and keep you as someone learning how to trade, right? If you see yourself as a guy trying to make money, you will be forever a guy trying to make money. If you see yourself as a guy who's already rich, regardless of circumstances, you will become rich, right? It's just the way it works. It's crazy, but once you know how to do it, you can make all the money in the world, right? So deeply rooted within your subconscious mind, you have a self-image, right? And a self-image is how you, not anyone else, how you truly see yourself, right? If me and you were speaking, one-on-one, face-to-face, and I asked you, are you confident in trading? But yeah, I'm dead confident. But deep within, you're not confident, right? You've blown prop firm challenges. You're afraid to lose, right? You can't follow your rules. Deep within you, that's how you see yourself, right? So we're going to have to change your self-image. I'm just going to suppose we have a trader. Now, you can use whatever income you want, but I want to change your self-image to a profitable trader who effortlessly earns 10K a month. Now, I'll be honest, if you're watching this, you'd probably like that, right? You'd probably like to be a profitable trader who's effortlessly earning 10K a month, right? That's what I got into trading for, and that's what happened, right? Once I understood this information. So your self-image now sees yourself as someone trying to learn how to trade, someone who isn't profitable, someone who's broke, someone trying to make money. All these things are negative because it's not where you want to be, right? You don't want to be a guy learning how to trade. Like, I'll be completely honest, like, you don't want to be watching my YouTube videos forever. Like, be honest, right? You want to make money and then move on with your life. And it's sad, one day you are going to unsubscribe from me, but God bless you in your journey. This is what you need to do. You need to start convincing your subconscious mind that you are already there, and then reality must catch up, right? This isn't some woo-woo BS, right? This is what anyone who's successful in any sort of industry, this is what they're using, right? Donald Trump, Conor McGregor, The Rock, Arnold Schwarzenegger, anyone is using this, right? But they don't teach you this because it's very hard to make money from, right? As you can probably tell from this video, because you're probably thinking, Atif's gone mad, he's gone absolutely insane. So this is the please do learn from me, right? Please, I'm telling you from the bottom of my heart, I don't care how many people watch this, because obviously trading psychology isn't as interesting as liquidity sweeps. This right here is what makes you money. This is right here is what will change your life. Please do listen to me. I'm making this video actually for younger me because I really wish someone told them this. It's this right here. No one will tell you this because they can't make money selling you this, right? Because it's quite hard to do. They'd rather sell you some BS, right? Anyway, tangent there. We want to get your subconscious mind to believe that you are someone who's effortlessly earning, a profitable trader who's effortlessly earning 10K a month. Now, how do we do that? Before I give you the solution, which is going to sound very funny, your subconscious mind only understands two things, right? It understands images and emotions done repetitiously, over and over and over again. All the beliefs you have were done repetitiously, usually when you were a kid, right? You were told, money's hard to make, money doesn't grow on trees. Over and over and over and over again, it went into your subconscious mind, buried deep within there, that money's hard to make, when money's really easy to make, really easy, right? Like once you reprogram your subconscious mind, you'll have money flying to you. I'm not even joking. I get random money just coming to me. It's the easiest thing in the world to make once you know what you're doing, right? Once you know how to reprogram your subconscious mind, right? So your subconscious mind understands, let me do this, right? Understands images and emotions done over and over and over again, right? But the solution really is to convince your subconscious mind that you are already there, that you are already the man you want to be, right? This is what visualization is. This is what affirmations are. This is what everyone does. You want to see yourself as the man before you actually become the man, right? You want to see yourself as who you want to be before you actually become who you want to be, right? And there's a lot more that goes on to that, right? The law of attraction, heaven and earth will move to make sure that, whatever's in your subconscious mind comes true. But you're going to say to yourself, among many things, this is just a cheap and easy solution, right? Because I'm not going to give you, hemi-sync meditations. If you keep saying to yourself, I'm so happy and grateful now that I'm a profitable trader over and over and over again. And you need to feel the emotions. Don't just say, oh yeah, I'm so happy and grateful now that I'm a profitable trader. Oh, but it didn't work for me. Atif lied. No, that's not going to work for you. You have to say it over and over and over again and actually believe it, right? This is what faith actually is. You know, a lot of you are religious. Pray to God, say, God, please, I want to be a profitable trader who earns 10K a month so I can provide for my family. And then act as if you were already that person. That's what real faith is, right? That's what real faith is. Don't just wait, oh God, you know, show me 10K a month and then I'll believe. You believe first and then you will receive, right? You won't receive first and then start to believe. So a lot of people get that twisted up, but you need to convince your subconscious mind that you are a profitable trader. So if you say this over and over and over again, eventually your subconscious mind will start to accept this. But the key thing which I'm starting to, or at least what's really helped me out, is you want to have an image attached to this, right? If I say I'm so happy and grateful now that I'm a profitable trader, like, what does that even mean, right? For each person, it means something completely different. You might want to be a trader in Dubai, managing $1 million in prop capital. Some of you want to live in New York, or you want to live in the countryside. Some of you want to retire your village, like wherever you live. Whatever you want to do, you want to build, and this is really, really important here, right? You want to build, use your imagination, build your dream life. Every single thing, the exact place you're living, the shape that your body is in, how much money you have in the bank account, what does your trading portfolio look like? Are you managing private capital? Have you got your own personal account? Are you managing prop firms? Are you like, I don't know, going to like trading networking events? Every single thing, you want to have that built. If I was you, I'd write it out on a Word document, your exact dream life, every single detail to it, the friends you have, the car you drive, every single thing. And then whenever you say, I'm so happy and grateful now that I'm a profitable trader, this image of your dream life will keep coming up in your mind over and over and over again. If you keep saying this every single day, over and over and over again, and you have that image, right, that key image of your dream life, eventually, not even eventually actually, what will happen is, and you've probably heard this, right, where it's like, it takes 3 weeks to change a habit, 21 days, you like, be honest, you've probably heard something like that, right, from Atomic Habits, where it takes like 21 days to change a habit. What that's really saying is it takes 21 days for something to come into your subconscious mind, right? So if you keep doing this, within 3 weeks, what will happen is your subconscious mind, instead of seeing you as a guy trying to learn how to trade, it will see you as someone who is a profitable trader who effortlessly earns 10K a month, because your subconscious mind cannot tell the difference between what's real and what's imagined. Whatever you tell it, whatever you literally imagine, it believes is true. There's no ability to think whatsoever. All your thinking is done by your conscious mind. But like we said, 95% of your results are coming from the subconscious mind. So this right here is the genie. This right here holds the keys to the kingdom. We need to solve this, right? So how we do that is we have an image. We keep saying, I'm so happy and grateful now that I'm a profitable trader. Now, you should do visualizations, which is really easy. Literally close your eyes and just imagine living your dream life for 10 minutes or however long you want to do it. And then your subconscious mind will literally believe that that is true, and it will do everything possible to bring that into reality. And what will happen is within 3 weeks, within 21 days, your subconscious mind will genuinely start to believe that you are a profitable trader earning 10K a month. And then that's where the magic happens, right? That's where the law of attraction, that's where the good stuff happens, right? You will just start attracting random things. And I don't want to spoil it for you. I don't want to spoil it for you, right? Because let's be honest, 90% of people watching this have probably clicked off. If you're watching this far, you definitely have what it takes. I'm telling you, keep doing this over and over and over again. Attach the image of what you want to it. Ignore everything that happens outside. Like literally ignore everything your eyes tell you. If you go on a losing streak, ignore everything. Just stick to this, right? Because what's actually happening is the entire universe, God is rearranging the entire universe to ensure that you become a profitable trader. So at first, it seems like chaos is happening. Things are going backwards. But trust me, if you persevere, if you have faith, you will become a profitable trader, and it will happen very fast and effortlessly, right? And you'll see the magic happen. You'll see the magic happen, right? If you know, you know. You'll just see, again, you'll just see things you couldn't even believe just happen to you, right? So for example, let me give you an example. You might end up, you know how prop firms do a giveaway, like a 100K giveaway? You might be in like Africa or something where you don't have much money. You'll win like 2 giveaways back to back. Like you've got 200K in capital, and then you'll go on like a 5 winning streak, and you'll make like 20K. Like, and that will all happen in like a month. Do you know what I mean? You'll go from broke to 20K in a month. Like, just crazy things like that will happen, right? I went straight up to 37K. I went like just massive, like crazy money was going. Like, I went from 0 to 10K a month. All these weird, just within a few weeks as well. Like, just absolutely crazy. So this right here is a genie. You have to convince your subconscious mind that you're already profitable. That is the only way you're going to fix your trading psychology. It's not, meditation's important, but you want to visualize, right? You don't want to just sit there and with your eyes closed thinking about your breath, because that's not going to make you profitable, is it? It's not going to make you profitable, is it? You want to sit there with your eyes closed and visualize the exact type of trader that you want to be. Journaling is only good to identify what's holding you back. For me, it was fear. I was afraid to lose. And the moment you know what's holding you back, you need to fix it, right? And the way you fix it is you see yourself as a profitable trader. You have an image, clear image of what that looks like attached to it, and you do it over and over and over and over again, and you persevere, right? This isn't just some overnight fix. However, it's within a few weeks you will start to see massive results, and within a few months your entire life will change. So if you want to learn more about trading psychology in general, check out the pinned comment down below where I go even more in depth into this, because obviously there's only so much I can do in a single YouTube video. And if you want to learn everything that I know about trading psychology on YouTube, check out this video on screen now.